games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What does it take to be a great surgeon?
This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
We've definitely been in somewhat of a rolling recession, but we could all agree we have not been in a labor market recession.
These kinds of numbers, you'd really have to question whether the economy is slowing down materially at all.
Underneath that surface, we are seeing some signs of concerns that make us worried about the sustainability of the jobs expansion.
To get inflation down to 2%, the only way to do that sustainably is have a big boom in productivity growth of 2 to 3%.
You don't have to have an economic collapse to get the inflation rate lower.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just slightly negative on the S&P following the first weekly loss on the S&P 500 going back to October. Two stops this week on the calendar. TK, CPI coming up on Thursday. Earnings for the big banks kicking off Friday.
Both hugely anticipated for different reasons. The banks, it's going to be a real measurement of the state of the economy. There's some gloom out there. Last time there was two, and the banks delivered. But on the inflation side, I found it very mixed. I looked at ECO. First thing I did today was look at the ECO screen, and it's a jumble. I would call the inflation report coming out, John, a jumble this week.
The data so far more consistent with a soft landing than a recession, according to Mike Gaper of Bank of America. Ellen Zentner and Morgan Stanley. Lisa, we continue to project a soft landing for the labor market. Will the data we get this week speak to that?
That's really one of the big angst, especially as you talk about what can go wrong, right? What can break this idea after really messy data on Friday. I want to just emphasize this. The number of takes that I read on what the data from Friday, both the non-farm payrolls report as well as ISM services data, what that said about the economy ranged from, well, you got to trust the headline number to all this data is completely messy and you can't trust any of it. I mean, that was essentially the message that I got from all of the notes. They were each picking out their own little quadrant to really focus on.
What can go wrong? The answer to that, Standard Chartered, Eric Robertson. Sounds a little bit like Max Kettner here, TK. In our view, rate cut expectations are disappointed and the market has to price short end yields higher. That's what can go wrong.
Yeah, that's out there. And I think you to highlight Max Kettner last week of the changing tides that's out there from someone that was uber bullish over to some real caution here. But, you know, and to get to Sharon Bell, who's going to come up in a moment here with Goldman Sachs, John, you devolved down from double-digit OMG, boy, NVIDIA went to the moon returns. down to good old all-American single-digit returns. How boring.
High single-digit returns over in Europe. That's what Goldman's looking for.
How boring.
Yeah, we'll take that, I think.
It's mundane.
It's pretty decent. It's mundane compared to the 24% gain we got on the S&P 500 last year.
On a Monday, it's mundane.
Okay,
thank you.
Let's move on. The scores on the S&P look like this. Equity futures negative by 0.1%. If you want a single name, it's Boeing. It's tracking lower. It's negative by more than 8%. Lisa, more to come on that a little bit later.
And we'll hear about Tom Sojourns and why you should wear a seatbelt. Coming up, John mentioned the two major data points of the week. The first one being CPI coming on Thursday, the latest read on inflation, how much it really does drip back down to that soft landing, disinflationary narrative. I'm going to throw another narrative, though, into the mix. You talked about bank earnings, and I'll get to that in a second, but we also do have Treasury auctions, and we're talking a lot, John and Tom, about this question around the rising deficit and how much debt issuance there has been over the past few years. Just the outstanding public debt in the United States from the U.S. government has risen to $34 trillion from $14 trillion back in 2014. When you have 3-year, 10-year, and 30-year notes being auctioned this week, you get a read on how concerned people are over the longer-term look. To me, that's going to be telling. And then, of course, the corporate earnings. JP Morgan kicking off all of that on Friday. Bank of America also reporting that day, as well as Delta. Look at that. Over the past year, JP Morgan, shares up 25%. Bank of America did nothing.
Wow, that's a great board, Lisa.
That's the disparity that we're talking about.
Treasuries, the distinction for that story.
Wow.
TK, just very, very different. Let's get to Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Sharon, wonderful to hear from you. It's good to catch up to start a new year. Let's get straight into it. We've talked a lot about the dominance of US technology companies on the S&P 500 and beyond, talked very little about Europe. Why are you and the team so constructive for the year ahead on the continent?
Well, you know, I totally agree with what you said before. High single-digit returns would be great for Europe. And we had a good year last year. I think often that's, you know, overshadowed by the big tech stocks in the US doing so incredibly well. But Europe was up overall about 20% last year. That's a broad stock 600. But if you look at something more narrow like the Euro Stoxx 50, it beat the S&P in dollars, in total returns. It was up 27%. So actually, Europe had a great year last year. Mainly driven by earnings too. So valuation is not that expensive. If you look at the PE for Europe, it's sort of about 12 and a half.
Right.
So it not expensive, reasonable earnings, good returns, not too bad a place to be.
Yeah, but Sharon, I'm fascinated by what people are doing. If I go back to the beginning of the panic, early January 2020, basically the U.S. has done a double off of Europe, up 11%-ish or so versus up 6% on the stock 600. Okay, great. Now, forward, are people in Europe, are Goldman Sachs clients in Europe insisting that they need to own American tech?
Oh, that's a good question. Look, I think that they, generally speaking, that what you can't get in Europe or you find much trickier to get is good, high, strong growth. What you can get in Europe is cheap valuations. You can get good dividend yields, you can get share buybacks, and you get some modest growth stocks as well. But really high growth is something that is just much more difficult to get in Europe. There are fewer listed companies like that. So there's always going to be a bid from Europe, from global investors, for big cap companies in the US, huge, big liquid companies that can give you that global reach, but also that growth. And the tech stocks often do that. The other criticism I'd have on Europe at the moment is it's more exposed to China than the US is. So a lot of the growth it has had in recent years has been China driven.
On an aggregate basis, or you can take it to the sector or nation you want to, what does the German slowdown, the overall German economic challenge have to stock 600 investment?
Yeah, I'm probably a little bit less worried about that than China, although it's kind of the same type of issue because it's sort of global trade growth coming down. China's domestic demand has weakened and that hits Germany, so it's all the same type of issue. Germany does have a big issue. I mean, it used to grow based on exporting to China and incredibly cheap energy that it was getting from Russia, and now neither of those things are in place. And then on top of that, obviously the autos industry, massive industry, both for the stock market and the economy, being hit by potential new entrants, being hit by that move to EV. So absolutely, I think Germany's got lots of problems. But it's actually, if you look at geographical sales exposure of European companies, sales exposure to Germany is not that big. the biggest place of sales exposure for European companies is actually the US. Much bigger, about 3 times the size of Germany in terms of importance for European companies. So yes, I think Germany is flatlining at best, probably in modest recession, but it doesn't matter, I think, as much for overall European demand as people think.
Especially if you're talking about Ozempic, or if you're talking about Airbus, or if you're talking about, an Hermes scarf. I mean, this is a question about if the Magnificent Seven of Europe look very different from the Magnificent Seven of the U.S. and are still the Magnificent whatever number in Europe that you can lean into. And I'm talking Novo Nordisk, Hermes, and to some degree even Airbus.
No, totally. All commodities companies, they're dependent on global demand. Or financials, which are dependent on interest rates, etc. So I think the sort of exposure to German cyclicality, it's not zero. I can't deny that, and Europe's more exposed to that than other regions. But other regions have their issues too. As I mentioned, China growth has been weak recently. Obviously, Asia overall is much more exposed to that than Europe is. So Europe's got its problems, but then it trades on 12 or 13 times PE. With the DAX trading even lower than that. So I think it's reasonably well priced too.
Sharon, you mentioned financials, and this has been sort of also one of the widowmakers, although last year it did pretty well with European banks. And I'm just wondering if the ECB is going to be cutting rates, is that a good thing or a bad thing for European financials?
Yeah, I mean, I was very convinced by European banks through last year, and we were overweight pretty much all last year. We downgraded right at the end of the year to a neutral. I wouldn't be negative about European banks. I very much see it as a neutral at the moment. I think rates clearly have peaked. We do expect to see the ECB cutting rates from April and then cutting quite consistently every quarter from there. The Bank of England as well cutting rates from May. Those things are probably on balance not so helpful for banks. But equally, we think economic growth will be okay. So you won't see a big rise in non-performing loans. I think that interest rates are going to be higher at the end of this cycle than they were at the end of last cycle with 0 rates. So I don't feel the backdrop to banks is all that bad. And then final points on banks, they are also very cheap. They're buying back shares, they're paying extra dividends. So the returns you're getting on banks are often just by banks delivering you. They're very good cash flows at the moment.
Sharon, you mentioned where sales growth and sales would come from ultimately, geographically. Is there an underlying currency call that you're making alongside this equity call?
Yeah, it's interesting because, Europe often does quite well when the euro rises, which I know sounds odd because European companies are super globally exposed. So if the euro is rising, that should make it more tricky for them to do well. But actually, the euro rising is normally a good signal that global growth is strong, that Europe is not about to break up, that we aren't in a problem in terms of sovereigns. So we do have the euro rising. We have it rising to about 112. I think it's about 109 at the moment. 112 over this next year. So a modest rise in the euro. And we also have sterling rising to 135 over this next year. I think we're about 127 at the moment. So modest rise in European currencies. But to us, that reflects the fact that we think global growth will be okay. And we think that US interest rates are also peaking, and you'll start to see the Fed cut rates from March onwards. And all those things mean that it's a recipe for a slightly weaker dollar.
That's the ultimate call. Sharon, thank you. Good to catch up. Sharon Bow there of Goldman Sachs, looking for high single-digit gains for the Stock 600 TK European equities this year.
Yeah, I've never done this. I go to MEMB. I looked at the European index and the Standard & Poor's 500, and boy, there it is in your face, the tech difference, the tech distinction of America. Novo Nordisk, that's the Ozempic thing, isn't it? Nestle, ASML, okay, that's techie. Novartis, Shell, your LVMH, John, you're there daily.
Sure,
it's
yeah.
Number 10.
Yeah.
And the thing is just like completely different than the ginormous tech dominance.
What you heard there, though, Tom, was just a real constructive view on global growth.
Yes.
Really expressed in the FX market as well. So 109 at the moment on the euro, 127 on the pound against the dollar, and they're looking for 112 and 135, respectively, at least later this year.
Because of the growth that they see in the region, which will foster also better earnings calls. I will just say, she also mentioned the banking system. European banks had their best year ever versus U.S. banks last year. So this is the question about, moving to neutral, et cetera. What's more undervalued or overvalued at this point?
Yeah, hardly got talked about, Tom, because the banking system in America was really under the microscope.
Well, and let's be clear, we'll be under the microscope, including this week. when we see JP Morgan.
JP Morgan on Friday, Bank of America as well. If you are just joining us, welcome to the program. Equity futures just about unchanged on the S&P 500. Yields moving just a little bit higher by a single basis point, 4.0589%. The next stop for this bond market, CPI on Thursday. A lot of data this week. I think we get PPI on Friday as well, Tom. Will it continue to speak to that disinflationary trend which sets up rate cuts sooner rather than later?
There was just some really good work this weekend, and you know, I look at the annualized, 3-month annualized, 6-month annualized, some of the compendiums of what you look at, and whichever way you play with the numbers, the fact is disinflation is in order. So my question is, A, how do you get flatness or a reversal to higher inflation? And what is that timeline? That to me is the mystery. If you get a Jim Bianco market, how long does it take to get there, to me, is complete mystery.
Jim Bianco coming right up. When you ask people what can go wrong this year, they talk about maybe repricing rates higher. You heard that from Max Kettner of HSBC just last week. You're hearing it from Eric Robertson of Standard Chartered over the weekend. Jim Bianco has a very similar view on all of that. Just repricing rates higher, again, could be the big risk for the year ahead. Jim Bianco in the next hour on Bloomberg TV and radio. Coming up next, Bloomberg's Bobby Gosh on tensions in the Middle East. They have not gone anywhere. We'll talk about those tensions in just a moment. For the broader price action on the S&P 500, equity futures shaping up as follows. We are just about negative. Let's call it unchanged on the S&P 500. In the bond market, yields are just a little bit higher by a single basis point. The 10-year keeps hold of that 4 handle, 4.06% on a U.S. 10-year yield. From New York, good morning.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
We reject the statements by some Israeli ministers and lawmakers calling for a resettlement of Palestinians outside of Gaza. These statements are irresponsible, they're inflammatory, and they only make it harder to secure a future of Palestinian-led Gaza, with Hamas no longer in control and with terrorist groups no longer able to threaten Israel's security.
That was Antony Blinken, the US Secretary of State, speaking from Qatar during the latest shuttle diplomacy tour of the Middle East and warning the conflict could easily spread. We'll pick up on that conversation in just a moment. If you are just joining us, broader price action looks a little something like this on the S&P 500, going absolutely nowhere. Yields are higher by a single basis point, 4.057%. Crude at various times last week threatened to break out. Tom this morning breaking down by 3%, $71 and about 60 cents.
And again, we haven't said enough about this. With all the tension in the Eastern Mediterranean, I'm still thunderstruck where we are. And I guess the simple answer is the U.S. has brought on a lot of supply. I don't know if I buy that.
Keep going back to that number, Tom. 13 million plus. Yeah. 13 million barrels a day of production in this country.
We're going to drive forward right now with a conversation on the Eastern Mediterranean. We're going to digress here at the beginning on the illnesses of Washington. Bobby Gush joins us now from Bloomberg Opinion as well. I go back to 1919. Woodrow Wilson has to get to 1921. He's blind in his left eye, and he's had some major strokes after a history of strokes going back into the late 19th century. Woodrow Wilson was fragile. We've set up an architecture of identification of ill people at the senior level. Should we be up in an uproar that the Secretary of Defense was ill over the last number of days?
We should be, and the White House should be. The fact that the Secretary of Defense was ill and hospitalized, and the President didn't know about it for 4 days, I beg your pardon. We're in a situation where there are two raging wars with strong U.S. interest, let's put it that way. ISIS is active again. There are crises after crises after crises, and the President of the United States didn't know that his Secretary of Defense was out of pocket. That there are protocols designed to prevent something like that from happening. Those protocols all broke down. Something more serious than a mealy-mouthed apology from the Defense Secretary.
The bipartisan uproar is going to be tangible, but I would suggest it will focus on 1600 Pennsylvania Avenue. What should be the response of the White House?
Well, the White House should demand something more substantive by way of an apology from the Secretary of Defense, and the President has to figure whether he's satisfied with the answer that he gets from the Secretary about why he was incommunicado for so long, or at least he was that the White House was not told. This seems like a very basic, simple mistake to make, and had this happened in any major corporation, heads would have rolled.
You know what I'm really curious about right now? There was a terrorist attack in Iran last week. What was the chain of communication between the White House and the Pentagon at that time? And shouldn't they have found out where the Defense Secretary was at that point?
They should have.
What happened? Did no one talk to each other when that happened?
Well, it would seem that the deputy was sort of responding to queries. We're being told that the secretary's assistant was themselves sort of in bed with the flu, and this is where all the communications broke down. That does not strike me as a satisfactory answer, that if one person has the flu, the president is kept in the dark. That can't be right, not in this day and age.
Which is the reason why there will be inquiries, no doubt, and still ongoing questions. There already has been outrage from both sides of the aisle in order to get more information. Bobby, I do wonder, though, you mentioned two raging wars. One of them, we started the segment with Tony Blinken talking in Qatar, where he said this is a moment of profound tension in the region. This is a conflict that could easily metastasize, causing even more insecurity and even more suffering. This morning, we're getting news of strikes by Israel against Hezbollah in Lebanon, more significant strikes. Is this the escalation that Tony Blinken was talking about?
Well, this is certainly a bigger step by the Israelis than, for instance, the assassination of the Hamas leader in in Beirut last week. This is a Hezbollah leader. When the Hamas leader was killed, Hezbollah had a degree of separation. They could, not that they did in public, but in private they could say, look, this is not our guy that was killed. We don't have to respond ferociously. When their own guy is killed, it would be much harder for them to justify anything short of a major response. This is the potential for escalation here, shall we say, is really, really great.
The role of some of the warships that the U.S. sent over to the Mediterranean, initially people were talking about this as trying to strike back or deter Hezbollah from attacking Israel. Is that the case, or is it to deter everyone from doing anything? What is the actual role of U.S. troops that are stationed in that region right now with a debate raging in Washington, D.C. about what the U.S. role should be?
Well, the Biden administration doesn't want those ships to get involved in any fighting. They're there to deter, but when the deterrence fails, then what happens? You know, I'm reminded of, there's an old, in Broadway, in the theater, there's this old cliche that if there is a gun on the mantelpiece in the first act, then by the third act, that gun has to be fired. That's what I worry about taking place here. The law of unintended consequences. If we've learned anything from the history of the United States in the Middle East, the law of the unintended consequences is not our friend.
We haven't spoken personally since the Maersk container shipping operation had to shut down again, can't go through the Red Sea, has to go through the southern tip of South Africa. Do you see that being resolved anytime soon? Is there anything that we can get a coalition together to do?
Well, we've warned, we have got a coalition together. There is a 10-nation flotilla of ships in the Red Sea. The Houthis have been issued with a warning, but they're disregarding the warning. So there's that question, well, what are you going to do next? You've issued an ultimatum. When the ultimatum is essentially waved aside, then what are you prepared to do? The shipping companies, I don't blame them for taking a zero-risk policy. They have, you know, enormous amounts of money at stake. They have people at stake. They have ships at stake. I can understand why they don't want to go into those waters. I can see why the Houthis would keep firing off their missiles, because they have not paid a price. The question is, at what point do they have to pay a price?
When you were holding court in Iraq, we used to keep careful count of how many Americans were in Iraq. Ian Bremmer, in his top 10 risks for 2024, has a fabulous chart showing the many pockets of Americans across the Middle East. I was really caught by how many it sums up to. From where you sit, do we have a lot of American military in the Middle East?
We've got lots. We've always had. We've just re-upped our deal with Qatar to maintain the American base there. That may be the sort of most important piece of this sort of complex network of American bases and installations all over. We still have troops in Iraq, and they are coming under constant attack by militias that are associated with Iran. Just last week, we had the United States took out the leader of one of those militias. So it might seem that the Iraq war is way behind us in the rearview mirror, but the facts on the ground for the American soldiers who are there, not so much.
Bobby, thank you, sir, for the update. Your insight, always valuable. Bobby Ghosh there of Bloomberg Opinion. We've got to go back to the disappearing act of the Defense Secretary in the United States. Lisa, you can move on quickly from this. I get all of that, but it's not exactly like the global backdrop at the moment. It's quiet. It's anything but.
That's the issue. And I think that Bobby actually raised one of the key points, which is this White House going to hold the Secretary of Defense responsible for really violating a chain of command and really giving the White House a heads up when there is a material shift in leadership?
Several big events took place last week, Tom. And I'm just wondering who spoke to who. Was there no conversation between the White House and the Defense Secretary when those things were happening?
All that will be analyzed, and I agree, it's a busy time when you're looking at defense, but far more than that is the heritage, the history of America across the 20th century. We have a constitutional amendment on this. We need healthy people at the top.
professional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
We are coming off the back of the first weekly loss on the S&P 500 since October. The bulls in this market have been absolutely spoiled for 2 months. We're kicking off 2024 with a week of losses. Your equity market this morning slightly negative on the S&P 500, down by 0.04%. The Nasdaq trying to bounce, trying to rally, up by not even 0.1%, up by 0.07. Turning to the bond market, 2-year, 10-year, 30-year, state of play right now, up a basis point or two at the front end to almost 440 on a 10-year, 4.06% on a US 10-year yield. We talked about that tug of war, Lisa, between the numbers we got on Friday. At the headline level, payrolls looked pretty decent, beneath the surface some cracks, and then literally 90 minutes later, we got the ISM services, and that didn't look good at all.
At a certain point, people are pricing in back to an 80% chance of a Fed rate cut in March after that ISM services data, after basically pricing it almost out, 50-50 chance just 90 minutes earlier. So here's the question. Which data do you trust? Is there a signal from the messiness of this that we are at a turning point, but we just don't know how far we are going to turn? That's the issue. Is this a more significant deterioration or just a slowdown?
It felt that way on Friday. We just don't know. TK, it really did feel that way. The 2-year yield, for instance, just to pick out one security, the front end of the bond market, that note, Tom, totally unchanged at the close on Friday after all of that information.
Yeah, I really take your point on that, John. I looked there at the close on Friday and saw the same thing as well. I just think people don't have a clue here. I mean, it's as basic as, do you clip the coupon or do you actually manage for total return this year after what we saw in 2023? That's a much tougher question.
Let's turn to foreign exchange and play, guess where? The euro, Lisa, guess where?
109.
Unchanged, 109.41.
You guys are killing it. I'm telling you, the FX coverage on surveillance today, folks, is a value add.
Goldman was looking for 112, so that's something. You know, a couple of inches higher. Their call on sterling, 135 and 127. Ultimately, they're looking for a better global backdrop, and off the back of that, a weaker dollar and stronger pound, stronger euro, I guess.
I love these exciting calls. 112. Woo!
Yeah, from 109.
Yeah, whoa.
50.
Crazy.
Basically where we are right now. Okay, enough of that. FX strategists everywhere, furious with us now after that. Okay. When there is some price action, we'll bring it to you. Under surveillance this morning, Boeing shares tumbling as carriers around the world ground the company's 737 MAX 9 from service after a fuselage panel blew off on Alaska Airlines flight on Friday. U.S. officials finding a key piece of evidence in their investigation, locating the fuselage panel in the backyard of a Portland-based teacher. Stock is down by 8%. The idea, just the very fact, the notion that no one was hurt after all of this, Lisa, is still just absolutely amazing.
A 63-pound plug fell from the sky into some guy's backyard, a teacher in Portland. Nobody got hurt. This thing blew off of a plane. Nobody was sitting in those seats. To your point, this is lucky.
Yeah.
But this is the point, at a certain point, where you have to really wonder what went wrong and how endemic is this to certain Boeing planes.
You know, the value add was George Ferguson with decades of experience, and he took it down to what he called fasteners. I called him rivets. If I'm United Airlines today, when the bar chart showed they have the most of these planes, whatever, if I'm United Airlines, you got to, maybe not today, but over the next week, check every damn fastener around every window on every plane.
Tightening all the fasteners.
I don't know what they do. I don't know the engineering aspect of this, but how can you do anything but that?
You mentioned United. There's a lot of airlines out there, Tom, waiting for deliveries from Boeing. There was a hope that they would ramp up production. Is that going to happen now after this? Go slow, go more carefully.
Nobody cares what my opinion is. You know, it's just wow. Just wow is all that can be said.
Stock is down 8%. Bramo cares. We all care, Tom. We care what you think. Let's finish on this. U.S. congressional leaders announcing a deal on a top-line spending level for the current fiscal year, lessening the chances of a partial government shutdown later this week. The deal includes Democrat demands to spare immediate cuts to domestic agency budgets, but lacks an agreement to block all conservative policy riders, an issue which could still cause an impasse. I think it was a positive surprise because I wasn't expecting it to happen last night, Lisa, but ultimately, as most guests have told us already this morning, don't get too carried away here going into the middle of this month and beyond.
The Freedom Caucus already called it basically a disaster. They don't like it. You have Democrats who are just trying to stay quiet as the Republicans try to work themselves out. They're razor-thin majorities in terms of the House and the Senate. How do you get something passed? I mean, do we really work this through in less than 2 weeks?
You know, Isaac Boltanski was pretty grim, and the answer is, doesn't it come back to, you know, the linkage of war funding with the migrant debate on the border? Period.
Well, let's get to that final story, Tom, on one of those foreign wars. Secretary of State Antony Blinken warning the Israel-Hamas war could, quote, easily turn into a broader Middle East conflict. Blinken looking to ease tensions in the latest trip to the area, making his remarks in Qatar ahead of more stops in the region.
Well, yeah.
This is a moment of profound tension in the region. This is a conflict that could easily metastasize, causing even more insecurity and even more suffering.
Lisa, Blinken set to travel to Saudi Arabia, Israel, and the West Bank.
You wonder what exactly their relationship is right now with Israel at a time where Israel is attacking Hezbollah much more dramatically this morning. And this is something that we're watching as the Houthi militants also attacking ships. At a certain point, the U.S. can't not get involved because ships are getting rerouted, and you have these sort of direct attacks on personnel in Iraq and other foreign bases. You start to wonder, okay, what's the tipping point here at a time when the government's mired in this pretty significantly?
And as someone said, I mean, where's the pushback? Where are we offensively going after people? I don't think we are right now.
We spent the last week trying to locate our defense secretary. I want to keep going back to it.
Yeah, I mean,
given how delicate the moment is, Tom, that story just sounds more and more bizarre.
Yeah, I agree. I agree. It's unraveling. If I'm the White House this morning, I agree. The tendency there is an unraveling of the illness of a Secretary of Defense. We're going to unravel to the bond market. Robert Tipp is Chief Investment Strategist at PGIM Fixed Income. I love, Robert, in your note where you say, everything considered, there is a strategic buy on bonds for 2024. What flavor of bills, notes, and bonds is the best strategic buy?
Well, most people's investment horizon, Tom, is long-term. And you asked whether this is going to be an alpha trading environment or a total return environment, and it's going to be both. That's what we saw last year. I think that's what we're going to see this year. At any given point in time, the market was up or down 5%. But by the time you got to the end of the year, it was up a handful of percentage points. Credit product had outperformed, and there was a lot of opportunity to make money in the zigzags in between. And I think that was the lesson from the Alaska Air. It's also applicable here in investments. You got to buckle up. You got to keep the seatbelt on tight and see what's going on out there. And right now, inflation is splashing down. You remember in the 1970s, it was a Twin Peaks, and the things that pushed inflation up the second time were rising energy prices, and part of that was a war. So, you know, we're going into a thing that did not feature in the Fed's minutes last week, not one time, the word winter. We're heading into that. It's cold in Europe. You have energy prices going up. You have tensions in the Middle East. that's another formula for something that could get in the way of these expectations for rate cuts. I think that's something we could come back to again and again over the year. A lot of back and forth.
Are you barbelling, or are you just simply bringing duration in?
I think we're going to be at given times long and short. Right now, we've had a spectacular rally. People dashed into this market. They extended the expectations of rate cuts, which are an entirely plausible scenario, which could very well come to pass as we go through this year, so it could be justified. But we're seeing, as we suggested in the note, some consolidation here as investors second guess whether you really are going to get 2 percentage points of rate cuts. In the U.S., what we saw Friday in that payroll number is there's 0-second derivative on the trajectory of this economy for all practical purposes. In other words, not accelerating, not decelerating, growth straight through. So the Fed has a single variable that's going to drive that decision on whether they're cutting rates or not at this point, and that is inflation. Does it stay down as it has the last 6 months, in which case they can begin to slowly cut rates. Other places it's more complicated. In Europe and the UK, they'll be looking at both growth and inflation.
You said something I want to pick up on, Robert. Are you basically looking to oil prices to determine whether to go long or short long-term bonds?
I think valuations are the critical thing here, and the risk factors. And when you get 200 basis points of cuts priced in, while the economy is growing just based on inflation being low, inflation can be very volatile. And the reality on the ground, as you cited there, is we have a situation in the Middle East. We're going into winter. Energy prices are volatile. And if that trend of the last 6 months changes, where we had below target inflation readings, that's going to slow down the Fed, because their motif of this cycle is don't do what they did in the 1970s, which was assume once you're coming down the first peak on inflation that the war was over. So I think that it's going to be a tactical environment here.
Yeah.
I think we're in the middle of the range right now, but the potential is there for moves in both directions.
What about the election, Robert? And I say this because we were just talking about the overhang of debt and how interest payments are going to take up a proportion of the overall budget that's enormous in the next couple of decades. How much are you watching this?
Yeah, well, that was the question people asked at the end of 2017. 2017 growth had moderated. People began to assume Trump would not get stimulus passed. And by the end of 2017, that all changed. Growth was rebounding. We had 2 stimulus packages passed. We had a surge in interest rates, just like we had at the end of 2016 when Trump won the election. So he's already marketing these extensions of tax cuts. That is going to be a very live issue as we go through this year, unless somehow that gets stomped out early on. But I think that's another real variable out there for the markets in this trading range, as the markets leap really from one guess on what's going to be the next big thing, either pushing rates up or down, making it a great trading market.
Robert, you're part of the market. You are part of the market. Is there a point at which you start to think, I don't want to buy treasuries because of this issue? Or do you wait for everyone else to start caring before you start caring? How does this work?
Yeah, well, I think that, number one, as Tom mentioned, the Fed is done raising rates for all practical purposes, as are the other major central banks. We put out our quarterly last week, as I put in there. We're past the peak in interest rates. Investors, as you can see, do not want to miss out this time like they did in the 80s. Once you had a big cycle, people wanted to wait for the next round of it. The Fed stamped that out as we rounded out the end of September, came into October. So I think this is going to be a market where you're going to earn the yield and you want to trade the range on duration, on curve shape, on spreads. But at the end of the day, when you look back 5 years from now, you're going to say, wow, this has been a great period in the bond market, and it all started when interest rates peaked back in 2023.
Robert Tipp, thank you, sir. Robert Tipp of PGIM Fixed Income. Lisa, just to think about that, how will you look at the bond market in 5 years, looking 5 years back? was it that ultimate time to buy and lock it in, which essentially is the point Tip is making, I guess.
And this is part of the reason why, if you look back in history, in the 3 months before the Fed started to cut rates in each subsequent cycle, every single time you saw yields come in, you saw bonds rally. So people are looking at history for that one.
If you are just joining us, welcome to the program. Equities right now on the S&P, only slightly negative, no drama here. We're down by 0.1%. An update on the bond market, yields up by a single basis point, 4.06%. I mentioned this note from Michael Semblist of JP Morgan's private bank a little bit earlier this morning on the boiling frog that may well be the deficit issue in Washington, D.C. By the early 2030s, the CBO projects that all federal government revenues will be consumed by entitlement payments, Tom, and interest on the federal debt. 2030 is not that far away.
Yes, that's the key point. The timeline is not frightening, but the timeline is tangible. What I would point out, John, is every discussion of this with every adult, every pro, is a comparison of these debt glide paths with our growth glide path, and that growth glide path not there.
Coming up in the next hour, conversation continues. Claudia Sahm, former Fed economist and founder of Sahm Consulting. Look out for that conversation in about 45 minutes from now. The broader conversation is about a market that has been better than good for the last 2 months or so, but kicks off 2024 with a week of losses on the S&P 500, down another 0.1% from New York City. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The question is, do we suspect that there is an overall design problem with this plane based on previous accidents involving the Boeing MAX? At this time, no. We are only focused on this investigation, this airplane. We are not focused on the fleet. But again, nothing is out.
That was Jennifer Homendy, the chair of the National Transportation Safety Board. The latest from the FAA, temporarily grounding the MAX 9 for safety checks after a fuselage section blew out during an Alaska Airlines flight on Friday. Alaska and United Airlines are the biggest operators of the MAX 9, shares of the airlines following Boeing lower this morning. Alaska Air is down by almost 6%, Tom. Boeing easing the losses just a little bit in the last hour. We're still down by almost 8%.
And it wraps around the airline industry. I mean, Alaska Air happened to be the airline where this occurred. I don't hear people blaming Alaska Air for it. We'll see. But I just wonder what the airline business is heading for in 2000. This shock is there and tangible, but they've had a lot of shocks and really struggled to rebound off of COVID.
You tell me how the consumer holds up, and I guess I'll answer that question for you.
I don't know. We're going to have to see. It's going to be absolutely fascinating when you have George Ferguson at Bloomberg Intelligence. That's a good place to start. We'll have continuing coverage of this. Brooks Sutherland for Bloomberg Opinion. Very, very good, particularly on Kansas manufacturing. Helene Becker joins now, Senior Research Analyst at TD Cowen. And we're thrilled that she could be with us today. Helene, January 22nd, I guess we get an earnings report from United. The others will line up. What is their urgency to act, not so much off the Boeing accident, but their urgency to act because of the topsy-turvy markets they're in?
Yeah, I think that we have a situation where we're expecting, or we saw fourth quarter traffic was pretty good. The further we get away from 2020, the more we'll see managed corporate travel come back. I think the trip where you have maybe a one-day trip isn't coming back anytime soon. I feel like it's a lot like after 9/11, Tom, when the really short-haul trips went away, and we expect that to continue really now. But the longer-haul trips, people need to get out. They need to see their clients. We've been talking about this for about a year now. And we're seeing that. We're seeing that increase in managed travel. And we think that will continue into the rest of this year.
With the Boeing accident, with the rivets, the fasteners, whatever we're going to see in the coming weeks of that analysis, even months, I should say, of that analysis, what does it mean for the dynamic of refleeting, a word I discovered last week? I think, Helene Becker, you know, refleeting is going out and buying the bright, shiny new thing. Is that accelerated?
Yeah, well, yes and no. American did their refleeting in the last decade, so they're on the downside of that. United is doing it now and into 2032. Delta is in the middle of it, but Delta has a different, and Southwest actually have different viewpoints on the way they refleet. They kind of spend about 10% of revenue on CapEx, somewhere between 8 and 10%. Every year, so they're continually refleeting. So we view that fairly favorably. I don't think anything changes. There's a lot of pressure on the industry to lower their carbon footprint. I know aviation only makes up 2% of total transportation carbon, but others are doing the whole reduction carbon faster, so aviation over time will become a bigger percentage of it. So there's a lot of pressure to fly younger, more fuel-efficient aircraft.
Helene, I can't get past this comment from George Ferguson, words you never want to hear, when he basically came out and said, it's not as safe as it was before the pandemic, talking about the safety of flying at a time when we did just have this incident with Alaska Airlines, also the incident that we saw in Japan, questions around the competency and staffing levels at some of the agencies. Are you concerned? Do you feel like that is an accurate statement, that it is not as safe to fly today as pre-pandemic?
No, I disagree with that completely. The fact that there were no casualties on the Japan Air A330 is hugely significant. They were able to evacuate that entire aircraft without any incident, with half the emergency doors being unusable because of fire. So I think that's one thing to consider. I think from an aviation perspective and a safety perspective, every time there's an incident, there's an investigation. There's no cover-up. You never see that as you would as you may in some other industries. There haven't, not to jinx the industry, but there really haven't been any major accidents. The fact that Alaska Air's pilots were able to declare an emergency turnaround, land safely with no injuries, is hugely significant. And I think aviation is still the safest form of transportation. No other industry does the deep dive into accidents that aviation does, and then aviation trains for every accident. And I think aviation is still very safe.
I think that a lot of people will point to what happened in Japan and point out that that plane that everyone did manage to get out of, I believe, was an Airbus and not a Boeing.
Yeah.
But
Nevertheless,
so going forward, though, I am curious, what about some of the air traffic control issues and some of these other things? How important is it for airlines to do some sort of PR job, if nothing else, to assuage some of the concerns of neurotic people like myself, where you're looking at this and thinking like, I don't know?
Well, I think you have to think aviation is safe, number one. Number two, yes, we do need to address the air traffic control situation, and the fact that we now have a permanent administrator is hugely important. That's another thing that we view favorably. The FAA is certified to March 8th, so the government needs to really step up its efforts and get it certified permanently. My views are different than some of my peer group. I personally think the government should be responsible for safety and security, and I think air traffic control should be a separate corporation that's public, that's paid for everybody. Right now, General Aviation, Tom and Lisa and John, don't pay for using air traffic control system.
Helene, I wish we had another hour to cover this, because I think it's something each and every listener and viewer want to know about. Back to the Reagan uproar and unions of years ago, how different is our transportation safety structure versus other major developing countries?
Yeah, so Eurocontrol runs Europe, and that's a public company, and Nav Canada is a public company in Canada. It's just run differently, and I'm not saying it's better. I'm not saying it's worse. I'm just saying it's different, and you don't have the puts and starts that you have here. I've been talking about next gen since I started covering the industry 4 decades ago, and we're still talking about it. It's years behind schedule. It's over budget. Air traffic control, to your point, Tom, the Reagan administration fired all the air traffic controllers. They retrained them. NACA is the union that represents them. They're well trained, but they're overworked. They're fatigued. We don't have enough of them to handle what we're doing right now. And so the aviation system will slow down. You won't be able to, we'll see growth through replacing smaller aircraft with larger aircraft. We don't think we'll see the same level of pilot hiring in 24 and 25 that we saw in 21, 2, and 3. But from that perspective, as we move further into the decade and people have more experience, that will be beneficial. But we're not going to grow as fast as we grew in prior decades because we just don't have the experience. And we can't push the air traffic controllers to too much overtime because it's a very taxing job to begin with. And we don't want any accidents to occur in the U.S. Because we want to continue to be able to say it's the safest form of transportation.
Helene, I've got 60 seconds left on a clock. Top pick, favorite trade this year, what is it?
Oh, yeah, our favorite trade this year is Delta, after United was our favorite trade for the past 2 years.
Why the change?
The difference in CapEx, frankly, is the biggest difference. I think United will continue to do well, but they're going to borrow a lot of money. They have a $60 billion CapEx program between now and 2032, and Delta's is not nearly as big, so you won't see the stress in the balance sheet that you may see at United.
Interesting. Helene, thank you. Thanks for the update. Helene Becker there of TD Cowen. Thank you very much. TK.
United, 72% debt. I didn't know that. She's great. Every time she's on, I'm just wowed by her history. 43 years ago, Reagan air traffic controllers. Helene Becker was blistering there.
Bring up the stock board just quickly. You can see the clear underperformance of the airline that's more dependent on this particular jet that we're all discussing over the weekend. Leicester United, down by 1.4%.
And the others eking out gains as people look out toward the future, what kind of grounding this could actually look like.
More to come on this market. Big week ahead. Earnings on Friday from the big banks. CPI data coming on Thursday. Jim Bianco of Bianco Research up next.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
it's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
When you look at where the Fed is right now, there really isn't that consensus for a March rate cut.
It's that the Fed that is going to cut this year. I think that's what's important, and that those cuts are likely to happen by around mid-year.
I do think the Fed is a little frustrated by the fact the market always must be more dovish than the Fed wants.
We're in this inflection point. The Fed has clearly done in terms of how much they're going to raise rates.
We're quite a long way away from that reconsideration of rate hikes, but it's not totally out of the realms of possibility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. After the jobs report, on to inflation. Forget about it. A world turned upside down in moments. James Bianco will join us, macro strategist, Bianco Research. John, if we get a Bianco market, all hell breaks loose. Yields go higher.
Looking forward to catching up with Jim on the risk of higher interest rates. We heard that from Standard Chartered. You heard that as well from HSBC last week. Let's start this morning with a question from Mike Wilson of Morgan Stanley. The question is whether this rally was simply a year-end short squeeze or a sign that the macro fundamentals are finally about to improve in a sustainable manner. Look, it's early days as we stumble out of the gate in 2024, but the data on Friday did not speak to that re-acceleration, that latter point of Mike Wilson.
I thought that Mike Wilson was exceptionally acute this morning. He lays out 1, 2, 3 different scenarios that are out there. And there was huge uncertainty within the Wilson note. So I got to go back to earnings, and that begins this week with JP Morgan on Friday.
And Bank of America, and it's not about the numbers, it'll be about the forward look. It always is. Trying to get a forward look from the recent economic data, Tom. The services ISM on Friday. Payrolls gets all the headlines. The services ISM that came out 90 minutes later really whipsawed this market. If you go beneath the surface and look at the employment sub-index, Tom, the biggest contraction since 2020. So payrolls look great at the surface. Beneath the surface, some cracks. You go into the ISM, and in certain aspects of it, Tom, looked absolutely dreadful.
It really, at least it's a social overlay almost of the market. We're talking about fancy, economic macro babble. And the fact is, some of those statistics show in America flat on its back. There's just no other way to put it.
It's a complicated market, and you've mentioned this many times, that we're in a pandemic economy, a post-pandemic economy with a lot of different cycles that are all kind of overlaid with one another. It's a complicated moment, which is the reason why Robert Tipp was talking about a trading range. It doesn't really lend itself to some sort of overriding thesis that can drive you through the year, as much as trying to understand where the balance of risks are and what's getting priced into the market.
Or the data dependency here. I mean, to both of you, the basic idea to me is the arc here of what the earnings season will bring. And there's some tangible enthusiasm, Lisa, about earnings. I mean, there's some legit enthusiasm that the gloom is too gloomy.
Well, some of the M&A can't go much lower, and certainly some of the certain IPOs and things like that for the banking sector in particular, which kicks off the earnings season. This is really going to be the key point. And Lori Calvasina of RBC Capital Markets was talking about this earlier, that basically it's all going to come down to the earnings. Mike Wilson also. You have to see a reacceleration, or else this rally that we saw at the end of last year doesn't make sense.
I mean, looking, John, here, we've got some headlines coming out. John, I think these are important enough where we've got to cover them right now. And this is George Ferguson at Bloomberg Intelligence giving us wisdom on Spirit. They'll share further information on protocols with regulatory authorities. Spirit Aerosystems is really front and center in this burgeoning investigation.
Not to be confused with Spirit Airlines. So that's Spirit Aerosystems. Still looking for further information, Lisa. Boeing is down by something like 8% this morning.
This comes after they had other issues in 2019, crashes that did actually result in people getting injured, but people focusing on this to understand going forward. What does this mean for Boeing? What does this mean for airlines that depend on it, including United?
Well, we will have to see. It is our interview of the day, without question. Jim Bianco, President Macro Strategist at Bianco Research, has really taken territories here to say disinflation is not in order. We'll see some form of leveling in inflation, and then perhaps an increased inflation, and with that, higher interest rates. He is with Bianco Research. Jim, the call is extraordinary, and now people are really beginning to pay attention. Put a when on it. What is the timeline you perceive to when we'll see the shock of higher interest rates?
Well, start with inflation. You could actually make the case that the year-over-year level of inflation bottomed in June when it hit 3.0%. It's at 3.1 now, and probably later this week when we get the December number, it'll probably go to 3.2 or 3.3. And that might be essentially it, that the inflation rate has found its low, or its last mile is here, or very close to here. And if it starts trending higher, I think then you'll start to see interest rates respond in kind, because what they've priced in is this idea that we're on our way to 2%. We're just quibbling about when we're going to get there, not if we're going to get there. And if we're starting to go the other way, I think that yields start going higher. Doesn't necessarily mean the Fed has to raise rates, but the idea that the market's got 5 rate cuts priced in, 6 last week, 5 now, that might be wildly optimistic.
When the price theory and the ambiguity of higher interest rates, does that come with better GDP or worse GDP?
No, I think it comes with better GDP, and I think that that's part of the issue here. 2023 is not quite in the record books yet. We haven't gotten the fourth quarter, but it looks like a 2.5% to 3% year. That's at least trend, if not above trend growth. We're looking at, if you believe the Atlanta Fed, and it's as good as any other measure, about a 2.5% fourth quarter after a 4.9% third quarter. So we slowed from the third to the fourth quarter from way above trend to probably trend or slightly above trend. So there is no soft landing in this economy right now. I mean, that's kind of wishful thinking. And the employment report on Friday really underscored that. It's not maybe an outright boom right now, but it certainly isn't a soft landing, and that will feed into it.
Jim, let's get into the data on Friday. Can I just jump in? Because it looks strong on the surface on a headline number, but going beneath the surface, this from Anna Wong of Bloomberg Economics, a drop in labour force participation, more people taking part-time work for economic reasons, a decline in working hours. The ISM was just dreadful. Are we not putting a lot of weight on the December data? How would you read some of that?
Well, two things. First of all, I think that we have to be careful with December and January. There's a lot of seasonal factors that come in at the end of the year that kind of skew those numbers a lot. Second of all, I think what we also have to look at is whether or not the nature of work has changed. I know I've been on here many times talking about we are in a remote work world right now where people go to the office 3 days a week, maybe 4 days a week, no longer 4 or 5 days a week. And that has changed a lot of things about the outlook for work and how we work. And really what we might be seeing in some of that data with like the increase of part-time jobs is the nature of work is changing as opposed to that it is a sign necessarily of weakness. You certainly don't see it in other numbers like the initial claims number in the low 200,000s. That's typically a number over the many years that we've been watching it is a number that is associated with a very strong labor economy.
So at this point, Jim, you were saying that yields could go up, you could go down, you could end up in this trading range. How important is CPI coming up on Thursday to really indicate whether this was just really noisy data that we got at the end of last week, or whether this was showing, particularly ISM services, some real weakness?
No, I think it's important because this month we should have maybe a small drag from gasoline prices. In November, there was a tremendous drop in gasoline prices, which is why the number was just 1/10. But now that we didn't have quite the drag on gasoline prices in December, we could get a true idea of what the underlying trend of inflation is without the noise of gas. And I think what we'll find is that underlying trend might be close to where we are on a year-over-year basis, somewhere around 3%. Remember, we're still at 4% year-over-year on core inflation as well.
John was mentioning earlier the budget deficit, and that's another kind of looming question hanging over just the inflation discussion in terms of where yields are going to be. And we were talking about this report, he mentioned JP Morgan, which showed that most of the tax revenues the U.S. brings in the next couple of decades are going to go to entitlements and to interest payments. That was based on an assumption that 10-year Treasury yields would be around 3.3%, or actually benchmark overnight rates would be 3.3% in 2033. Do you think that kind of projection is realistic, or do you think we are looking at a 4% world for the foreseeable future?
No, I think we're looking at higher rates. I think the 40-year bull market in bonds ended in 2020. We are in a trendingly higher environment for the next several years. Now, we could have a slowdown in the economy in a 2 or maybe a 3-year rally in the middle of it, but I think we got to start thinking about interest rates trending north as opposed to trending south. That ended, like I said, with the pandemic a couple of years ago. And as it does, we're going to see especially interest costs become a bigger problem. They just went over $1 trillion on a yearly basis that the government is going to be paying in interest, which is more than the Defense Department budget right now. And that's not going to get any better, at least in the next couple of years, because more debt's going to be rolling off at lower coupons and going to be reissued at higher coupons.
We've been talking about this now for the best part of a decade. You'd be the first to say, Jim, I'm sure, that we need a certain dose of humility around this particular topic. But the day of reckoning, just how far away is it, Jim? Surely you can't remain on this trajectory. What does that day of reckoning look like?
It looks a lot like what you saw, I should say now in 2022 in the UK with the gilts market and the LDI, the liability-driven investment problem. When the market decides that the day of reckoning is here, when the UK put out a budget that the market didn't like, it forced it to change. Well, the markets will do that too. So if we're going to keep borrowing debt and we're going to keep spending and we're going to keep running up, interest costs, at some point, it's not going to be a commission by the government that's going to fix it or a change in the leadership in the White House. It's going to be the market that's going to just put its foot down and say, enough, this is going to stop now, like it did in the UK in September of 2022. Now, whether that's next month or 10 years from now, that we could debate, but I do think it will be the market that will make that change.
Jim, the UK clearly didn't have the luxury of acting recklessly. Do you think the US does to any extent?
Well, it has because it's the reserve currency. And as long as it is the reserve currency, it is afforded a latitude that no other country is afforded because everybody else has to own our debt or own our currency because that's what trade is done in and that's what is the dominant currency that runs the world economy. But if we were to lose that status, and to be clear, I don't think we're about to lose that status anytime soon because there's a lack of an alternative, then yeah, that luxury will go away. But for now, we still have it, but we can't be abusing it because we're just going to force the day that it ends to come much sooner.
Huge numbers. Jim, great to catch up, sir. It's good to see you. Jim Bianco there.
Thank you.
Of Bianco Research on the possibility, the potential of resetting interest rates higher all over again. If you're just joining us, this is where rates are currently on a 10-year, higher by a single basis point, 4.057%. Just how close, TK, is that day of reckoning?
Oh, that's the whole thing, the x-axis here. But Bianco has just been way out front on this. He was early on it. Notorious on it, if you will, but the continued call here for higher yields really pushes against the disinflation story. What's so important there, and I asked it because it's a John Riding question, is just, okay, you get higher rates. Oh, that's terrible. We're all going to die. And Bianco is crystal clear, a la John Riding, or maybe that's a sign of a more resilient American real GDP.
It's the way they go up, right? How many times have we heard this? That if they go up just a touch because of how strong the economy is, that's okay. But if the market puts its foot down, as Jim Bianco was saying, and as we saw certainly in the UK in 2022, then it just sort of brings to mind what James Carville said, right? When he gets reincarnated after he dies, he doesn't want to come back as a perfect baseball hitter. He wants to come back as the bond market. You can intimidate everyone, and that is the reason why people are watching to see when the bond market starts caring much more about this deficit.
It was intimidating for about 5 minutes, wasn't it? Last year, the month of October, Tom. Slightly intimidating and then backed away for a couple of months.
Yeah, I remember.
I think overall the Treasury market just bullied everyone through 2023, including the banks and
no, but I remember
too.
A point where I was stating this is the technical construction of the market in October, and it was grim, grim, grim. And a week later, if I'd had money in play, I would have been absolutely shellacked.
You know, part of this has to do with the Treasury Department responding to the bond market and issuing different kinds of debt. Can they keep doing that? That's going to be a real issue.
That's one of the.
If you had money in play, you would be shellacked. Okay.
Theoretically.
Henrietta Trey's of Vader Partners is coming up next. Your equity market is totally unchanged on the S&P 500 from New York City. Good morning.
What does it take to be a great surgeon? This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We've been negotiating in good faith all through the holidays, every day over the holidays, except for Christmas, on the top line numbers. Congress has a responsibility. We have the power of the purse, of course, and we have to be good stewards of precious taxpayer resources. We cannot continue to borrow money to spend it. And so reducing non-defense discretionary spending must be a priority of Congress.
That was House Speaker Mike Johnson on CBS just yesterday, hours before an announcement that a deal was reached on top-line spending in Congress, easing concerns of a looming U.S. government shutdown. Maybe just a little bit of a bright spot as Congress gets back to work. Your equity market more broadly this morning, and good morning to you, is totally unchanged on the S&P 500. Yields are going nowhere, going somewhere, I guess, up by almost a basis point, 4.05% on a 10-year. Real tug of war at the front end of the yield curve on Friday. We've talked lots about that already. Payrolls growth looks solid, the rest of it not so much. And then you look at the ISM Services Index that came out 90 minutes later, and that wasn't great at all. So the 2-year was totally unchanged by the end of trading, Tom, in Friday's session. This morning, it's up by not even a basis point.
Take us back to that moment, folks, because this is 8:30 in the morning. Things look pretty good. We're looking at the revisions. It brings it down to 146. Anna Wong looks like a genius. And then, John, ISM comes out, what, 90 minutes later?
90 minutes later.
And it's, oops.
Well, you get all these sub-indexes, Tom, all these different reads. I'll go through some of it for you. So very close to stagnating in December. That's the overall read. Biggest drop going back to March, so the change was negative. Employment, biggest contraction since 2020. The gauge of unemployment in the low 40s. New orders index dropped to a 3-month low. You've got manufacturing earlier in the week has been in contraction since late 2022. Put it all together, Tom. Not great, but again, I think we all caution the same thing, the quirks of December. We'll see what the data looks like for this month and the next couple of months.
This is not Michigan confidence. This is countable data. Now, is it like weekly claims? No. Is it like other very countable statistics? But I'm going to suggest ISM is somewhat a countable idea.
It's survey data, but Tom, it goes completely against the grain. It goes completely against what we saw at the headline number in payrolls on Friday, which said everything's okay. That said something different.
Yeah. The euro's unchanged, 109.45.
Yeah, that's been the story of the morning, without a doubt.
That's been the story of the morning as well. What is the story? The story is your United States government, and we are thrilled to have in our studios Henrietta Trace, Director of Economic Policy Research at Veda Partners. We heard the Speaker of the House, you know, verbatim, I mean, there's no other way to put it, verbatim of Republican canon over decades and decades and decades. I want you to describe the distinction of the GOP hope to cut spending nominally or cut spending on an inflation-adjusted real basis. To me, the distinction is paramount.
I think that what we're looking at, the distinctions and the numbers between the House Freedom Caucus, the Speaker, and the new deal that they just reached over the weekend, and what Senate appropriators have done is so de minimis that to call this material deficit reduction is really kind of laughable to anybody who's, like Jim Bianco in your last segment, looking for earnest deficit reduction. That's not what we're talking about here. We're going to get a deal that basically has flatline funding, and then if you add on additional aid to Ukraine, Israel, et cetera, domestic supplementals, that's $55 billion the White House has requested. You're looking at fiscal year 24 spending that's above 23, no later.
Decades of this. I mean, I remember Ruth Porat now at Google. I mean, I remember being in a thing with her and Pete Peterson and a bunch of others. We've been talking about this for decades, and the distinction is the cutting of nominal or real spending. I mean, the British had an experience of real spending cuts a zillion years ago. Are we really going to do that? I don't see it.
No, there's no scenario where we're doing real cuts. The next best chance is if in 2025 you have a split House and Senate and White House. And the only scenario I see that happening is if Biden is the president and Republicans win the Senate and or the House. Then you have a massive tax bill that's due in 2025, and you can actually have a scenario where Democrats and Republicans are in a room negotiating $1 trillion, $2 trillion in tax changes, entitlement discussion, sort of the deficit commission, the super committee, that kind of stuff all over again in 2025. But you need to split Congress, and not this year.
What are you watching to understand whether this spending deal is actually making any progress versus a nice show of some progress that then just gets completely dashed as some of the details try to get worked out?
Well, this time around, Republicans, as you know, are having an even smaller majority. Math sort of remains undefeated, I guess. And when you're trying to count votes, you cannot get there for anything other than a Democrat plus Republican package, which means you're going to lose the far right. And it's up to Speaker Johnson to decide that he wants to barrel ahead. So my expectation is, despite this deal, you're probably going to get stopgap CRs that fund the federal government from January 19th to February 2nd. Maybe they lump them all together, and then we're doing that into March and again into April. The reality is we don't have a deadline until May 1st. And so they do not actually have to act until then, and I suspect we'll get a number of CRs despite the top line deal.
This is a massive week because we also are getting the Iowa sort of race heating up, heading into New Hampshire, and there's a real focus suddenly on 2024. Here we are and the election race. Do you think that the Lloyd Austin incident, where our Secretary of Defense went missing during a really serious period of time internationally, is going to make it into some of the discussion around re-election and platforms and what's going on at some of the top levels?
I think it'd be political malpractice for any of the Republicans not to mention it all day, every day. So as you go into the primary season, I suspect the Republican candidates will bring it up. I imagine that Trump is expected to be the front runner. That's my forecast for sure. He will bring it up for the remainder of the year. I don't see how that could be otherwise.
Can you help us understand what typically happens when there's a terrorist attack like the one that took place in Iran last Wednesday? Does the National Security Council reach out to the Pentagon? Where I'm struggling with this story, the disconnect for me, is why they didn't find out that the Defense Secretary was missing until Thursday, when these big things were happening. It gives me the impression, and I stress the impression, and I'm looking for some correction here if you've got it, gives me the impression that they don't talk to each other, even when bad things happen. Is there a correction there?
Not only are you not talking, but how are you telegraphing that you're not speaking? How are you not getting updated or providing some sort of press release even, or communication that, hey, here's where they are? You know, so apparently they all have them tracked and know precisely where they are if you're at that senior level. And there's
quite worrying, isn't it? This isn't just sort of a lapse in communication. It makes you think that they're not talking to each other.
It's unfathomable to think that they're not talking, so I think there needs to be some serious cleanup on aisle 2, and I suspect that we'll get that in the next couple of days, but the White House needs to step up the education on this one.
Yeah, TK, I'm really struggling with this story from over the weekend, really struggling with it.
I think it's indicative of the administration. I think they got a lot to talk about here. It's not going to go away, and even on a Monday, it's evolving.
You think there's just too much on their plate? Would you agree with that?
I think it's maybe an indicator of the cavalier attitude they have towards going into 2025 and the election cycle as a whole. If I wanted to extrapolate, I would say, what does this mean about their ability to understand where voters are on the economy? Where does this stand with voters' understanding of how the state of the U.S. economy is? 70% of Americans think we're in either recession, stagnation, or deflation. I mean, the telegraphing, the education needs to be upped, no question, and their messaging team and their press team needs to hear that.
What are you looking for in the Iowa caucus to understand exactly how the Republicans are going to shift this forward and who number 2 is going to be behind the assumed head, which is going to be Donald Trump?
Yeah, I'd love for the primary season to be a real bellwether, but I think that any of the candidates that are not named Trump are really going to have to wait until the RNC, until the convention. I don't see an opportunity, absent some seismic blow up for Haley or something in New Hampshire or South Carolina, that upends all this, but none of the polling data is giving us that indication. So I suspect that we won't have any upset until this summer with the conventions, should something happen with trials or somebody's health or something like that.
Henrietta, I want to finish on this because you kind of alluded to it. Do you get the feeling there's some kind of institutional arrogance here? The lack of communication? Do they need, dare I say, a marketing division to come into the White House and figure things out? Because they always seem to be completely bemused by the disconnect of where they believe things are and where the electorate believes they are.
I mean, never underestimate a Democrat's ability to not send a message and not clarify it.
It's bizarre.
It's permanent. It's just always there.
What is that about?
Oh, God, I don't know. I wish it could be fixed.
I can't understand it, TK. I just cannot understand it.
I don't want to get into the political debate of it. That's not our place here at Bloomberg, but I will say it's indicative of many things we've seen from this administration.
Let me give you an example from the media side of things. So for the last 3 administrations that I've covered whilst being here, every time you have payrolls Friday, you get the NEC director come out and speak every Friday to all of the networks about how strong they think payrolls is. This administration handed it over to the Labour Department. Completely different approach with this admin, and just one of those small examples from within the media on the disconnect between the administration and the communication. Henrietta, thank you. Henrietta Trace of Vader Partners from New York. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
60 minutes away from the opening bell, 1 hour away this Monday morning. Good morning. Equity futures on the S&P just about turning positive in the last 10 minutes or so. Last week, a week of losses, the first week of losses going back to October. It has been better than good in this market. We were coming off the back of the longest weekly winning streak going back to 2004. We had 9 weeks of gains, then a week of losses to kick off 2024. Looking at equity futures right now, just about positive. On the Nasdaq 100, up by 0.2%. The Russell, just a little bit lower, by 0.1%. Just want to turn to the bond market quickly. 2-year, 10-year, 30-year. Looking at the front end of the curve, we talked about that tug of war all morning. just that conflicting data. Headline payrolls looked pretty strong on Friday, and then you had this ISM services read where the employment index just didn't look great at all. The 2-year, actually, even after that payrolls number we got at 8:30, 2-year finished totally unchanged almost in Friday's session. The 2-year this morning, 437.25. The next stop for this market is CPI data on Thursday, and Mike McKee is looking ahead to that and PPI on Friday. Mike, busy week.
Well, I'm saying that I own this chair on Thursday because it's CPI. The rest of the week, it's going to be Katie Greifeld and Eric Balchunas on the ETFs for Bitcoin, and Sonali is going to own the chair on Friday for all the bank earnings. But we do get CPI on Thursday, and it's going to be very interesting to see what happens because we're going to have the same situation as Europe did, where the headline CPI, in theory, is likely to go up because of base effects. There was a negative print in December of last year, which means that we're going to see a little bit of an increase this time, but core is going to go down. So which do the markets focus on? The immediate focus in Europe was on the headline number, but then the Europeans backed off of that. So do we get the same kind of analysis here?
What's a goods services dynamic right now? Like, I guess the vector of those two, but what's the distinction between goods and services movement right now?
Well, the interesting thing is we saw in the ISM report that John was just referencing for services that services prices went down. We've already seen goods prices going down some, and so it appears that both are on track to continue falling over a longer period, but we're not quite there yet. One of the big unknowns is what happens with this Red Sea shipping situation. A number of economists on Wall Street have dug into it and forecast, and they see in the United States almost no impact, about 0.1%, because shipping costs are very low, very small as a part of the overall price in the U.S. It'll be more in the Europe, maybe 0.3, but it all depends on how long it goes on.
We get a bunch of Fed speak this week as well, in addition to Treasury auctions, which is the reason why I found it interesting to hear from Dallas Fed President Lori Logan over the weekend. This question around asset purchases and whether they should start to slow or taper some of the quantitative tightening. How much are you starting to hear about that and expect to start hearing about that in the next couple of weeks?
Well, this is probably the first smoke on the horizon for that. And of course, coming from Lori Logan, it makes a lot of sense because she was head of the system open market in at the New York Fed, and so she was in charge of all that. The question is, when do they get down to what they consider the minimum level of reserves, which will be above a minimum level? So they're going to have a sort of a built-in safety pad, and then do they start tapering it off? If you don't taper and you're lowering interest rates, you're working against yourself. So it probably makes sense to taper. So we'll hear more of that. The big Fed speaker this week is John Williams, because of course he's vice chair of the Open Market Committee. He's on Wednesday afternoon and he's giving a speech on the economic outlook. So everybody will try to read into that what the Fed's going to do.
Just to wrap things up, you mentioned sequencing. In the minutes themselves, did you get the impression they're starting to tee that up? Wind down QT before you start cutting rates?
Well, they get a Fed staff briefing. That's got to come first. They'll have another one probably at the next meeting, and you'll get a little bit more of a write-up of a discussion among them about it. They won't come out and say what they're going to do yet for a while, but maybe as we get towards the end of the first quarter, we'll see that. It was interesting, Lori Logan said we're likely to see the same problems that we had of a bit of a market seizure, because they really don't know where the ample level is. They try to figure it out. And I've always compared it to parallel parking a car in New York City, you know, where you get into this very small space and you back up until you bump into the car behind you, and you go forward until you bump into the car behind you, back and forth. And that's kind of, I think, the way they'll figure it out.
I'm not sure that's what everyone does, Mike.
Thank you.
Maybe that's what Mike McKee's been doing.
There are other ways to do it. I'm just letting you know.
Mike, good to see you. Mike McKee, it's a busy one for Mike. On Thursday, CPI, that's the big data point of the week. TK, then on to Friday, we'll get PPI, some jobless claims in between.
And in between, we'll have a tour. It'll be at Ann Arbor, Michigan. It'll be floats and celebration of Michigan and football. And because of that, we were ordered to have a Michigan economist with us now. Claudia Sahm will be up all night watching a football game as well. Claudia, for the Department of Economics at Michigan, all that heritage, what does blue football actually mean? Do you completely ignore it, or are you at the 50-yard line for every game?
Well, they don't let the grad students have very good seats, but we went. It's Michigan. Go blue, right?
Go blue. Oh, we'll see tonight. Thank you so much for joining. Claudia, Barry Ritholtz, you had a great idea out there that in our hysteria right now of single statistics, we have denominator blindness. Let's take the national debt, the interest expense of that, and we forget how large our economy is or how large our labor force is. How hysterical are we right now, and do we need to calm down?
Well, we've needed to calm down for decades. This is not a new conversation. The debt has to be put in context, not just of our GDP. That's a flow that we get that every year. We need to think about it in terms of, say, our wealth, which is multiples of what that debt is. And I'm also a firm believer, and we need to look under the hood and what are we spending our money on? There's good ways to do it, investment, R&D, and there's ways that aren't as good, maybe really high income tax cuts. So that's where we need to have the conversation, not just throwing around big numbers.
Is the Fed throwing around big numbers? Are they having a conversation as they move out into 2024 that you would consider appropriate and rational?
In terms of the debt or in terms of what they're going to do?
In terms of what they're going to do, their monetary policy, excuse me.
Yeah, no, I mean, the Fed is trying to do the impossible right now. My heart goes out to them, and we will play a parlor game for the next year or two and what their next move is. And yeah, they've got the eye on the prize, right? They work through financial markets, but they really don't care about financial markets. It's about getting inflation down. It's about keeping people with jobs. And we're well on our way, but it's going to be tough to know when they're there and can say, okay, we can back off.
Let's do an anatomy of what happened on Friday, because it was some confusing data that I tried to parse through and continue to, and read more reports, and I'm just as confused. Which data screams the truest to you at a time where we got a stronger than expected headline number, some real shows of strength, and then real signs of weakness, particularly in services employment?
Big picture, Friday's payrolls was a good day. Right, we had unemployment staying at 3.7%. We're averaging a little under 200,000 jobs in recent months. If you think about what the labor market is buffering, we have a 5 percentage point more than that increase in the federal funds rate. This is a strong labor market. Now, you can go under the hood. You can do this in almost any month and say, that doesn't look so good. Now, granted, there were some real signs, things to keep an eye on, and we always need to, but this was not a flashing red, we're going over the cliff. I mean, come on, the unemployment rate's been under 4% for the longest stretch since the 1960s. That's good.
What about the services ISM data? The fact that hiring fell the most, the sort of sub-index for that particular data point came in the most going back to 2020 at the height of the pandemic. Does this make you feel like we're at a tipping point, even if we're not heading into the abyss, that we are cooling off in a much more material way?
It's been the case that last year we needed to rebalance. We needed to get to a place that was expansionary but not red hot. I mean, we were coming out of a really bad labor market with COVID. So we do need to see things normalizing, slowing, not just this pace that's been so strong, because we want to get to a sustainable place. And there are going to be all signs. Frankly, I take a lot more out of the payrolls data than I do the ISM. We need to look at everything, and yet we've gotten a lot of mixed signals from the data, so far.
So readjust the SOM rule for us right now. How many states are in a miserable situation, Dr. Son?
So I haven't looked at every state recently. One that has stood out, and I imagine is still in the same place as California, that's a really good example of how you can have an industry that's having a tough time. I mean, tech in the Bay Area is legitimately having some tough times, and yet we have seen no signs of it spreading because it's an industry issue. It's not like a broad-based contraction. And I will say at the national level, the SOM rule went back down to 0.2 of a percentage point. So looking good so far.
Claudia, I just want to weigh in on some of the politics, and I don't want to bait you too much, but whenever I listen to you talk about the labour market, you offer clarity where clarity can be found, and where there isn't any, you leave the question open. It's really digestible, very, very intuitive. Why do you think this administration is struggling with the messaging so much around what's happening with this economy?
For a long time, Democrats have really put an emphasis on being the adult in the room. when I saw the jobs number, I had a GIF that I use. It's like, boom. It's like, come on, let's get excited about this. Yes, there's more to do. And yet when I look at all that has been accomplished in the last 4 years, and even during the Trump administration, the big push with CARES Act, we really help people. This is not perfect, but don't hide behind what you've done. Go out and say, we did a great job.
Okay, then why can't they do that? I mean, John brings up an incredibly important point, Claudia Sam. You've been in the trenches. Why can't somebody just come out, not say, rosy morning in America and all that, but say, look, we understand the agonies out there, but boy, has this worked out from COVID versus many other countries and continents.
I really don't know. I mean, I have come across the fact that across the Democratic spectrum, there's just so much anger at each other. I mean, I've gotten the worst feedback from far left. And, center isn't exactly happy with me either. So it's so strange, right? But, I don't know. I hate politics. I really don't understand it. I just keep doing my work and trying to explain and trying to learn from what people are going through.
And we value your work. Claudia, thank you, as always. Just fantastic to hear from you. Claudia Sam there of Sam Consulting. Tom, on the data, the labour market, and just towards the end of that conversation on the struggles of messaging in Washington.
Claudia Sam and others, studying under Ned Gramlich at Michigan years ago would aggregate. That's what you do. And there's so many parts of American society where you're not going to aggregate right now. I've brought it up a number of times. How can you be optimistic on the economy when you see the bankruptcy vectors that are out there right now? Just as one example. And then you've got, as she mentioned, the politics of it, far left, center, and for that matter, far right. But there's just a disaggregated sense out there right now.
I mean, honestly, I'm just looking at this and I'm thinking they got to get their message together, because right now the economic data looks pretty good. And yet, when you take a look at the polls...
Oh, dreadful.
I mean, that's the bottom line, is Biden is absolutely losing on the economy at a time where the economy just expanded at the fastest pace in years in the fourth quarter.
Just a massive disconnect, Tom. Massive, massive disconnect between where the administration thinks things are and how people feel about the current situation.
The disconnect is the polarity of America. There's a large body that I'm sure is cheerleading on Republicans and Democrats about how good things are, but I would say all in all that's relatively narrow, or at least they don't have the voice and the sound box that many others have.
If you are just joining us, welcome to the program. Equities just about turning positive on the S&P 500. Going into the opening bell about 48 minutes away. We're positive by almost 0.1%. A little bit later on this morning, in the next segment, Barton Crockett of Rosenblatt Securities on tech. TK, conversation about tech stocks. Apple, for whatever it's worth, Apple having one of the worst weeks it's had going back to September last week. We got a downgrade from Barclays, another downgrade from Piper Sandler, just setting you up for that negativity quite early on in 2024.
Well, Barton Crockett's is someone who speaks frankly. It'll be interesting what he has to say. Let's remember CES, which I've never been to. Lisa, have you been to CES, the Las
I've
Vegas
never been there.
Tech extravaganza?
Ed
Ludlow's there.
He's there. Good.
They do new stuff. They're going to do the thing where you look around.
Virtual
like
reality.
This. Yeah, is that
Could I just point to one tech story? The Apple phones that fell out of the plane. One of them survived intact.
I saw that, yeah.
It fell 16,000 feet. Fell on the ground.
If you drop this now, 5 feet,
it's going to crack.
It's going to crack.
And I'm going to have to buy a new one, and I'm going to resent it.
What is that about?
I don't know, but this is shocking. I want to hear more about this phone. And
I'm guessing a sales rep went and put one there. I'm joking.
You are such a conspiracy monger.
It's a joke, Bramo. Futures on the S&P just about positive from New York City. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The next 3 to 4 quarters, you're going to have iPhone growth. You have growth coming out of China, despite the fears and obviously a lot of the bear noise. And I think the most important thing is services. I mean, I think services is going to be teenager type of growth. That's key to the multiple expansion story. This is going to be viewed as more of a golden buying opportunity rather than the start to, hit the elevator exit.
That was the bullish view from Dan Ives of Wedbush on Apple and tech more broadly. The equity market had a week of losses last week. Apple responsible for at least some of that after a couple of downgrades from 2 key analysts that we'll get into in just a moment. To kick off this week, the second week of 2024, equity futures here, Lisa, positive by 0.04%.
Let's get into that right now. We saw more than a 5%, almost 6% decline in Apple over the past week. This is the first week to start the year. Microsoft down 2.2% and Amazon down 4.4%. Is this an Apple issue, given the fact that people are downgrading how much Apple can meet their price to earnings ratio versus the slowdown? Or is this something else that is broader tech? And that really is one of the key questions facing 2024.
Really tough start to the year. That stock down 5.9% last week. Growing concerns over the iPhone and sales, triggering 2 downgrades to start the week. In just the first week of the year, Barclays downgrading the stock to underweight from equal weight, and Piper Sandler cutting its price target 260 from 343. Rosenblatt Securities retaining its neutral rating on the tech chart. The analyst writes in this: we admire Apple's position as the maker of the world's most important device, the iPhone, but without disruptive new products, sales seem to be stuck in a muted place. Barton Crockett, senior research analyst at Rosenblatt Securities, joins us now for more. Barton, let's talk about that. The prospect of sales picking up for the iPhone and what's been holding them back over the last year.
Well, look, I think that, we downgraded Apple in August, early August. We currently have a $189 price target neutral rating. And, our concern at that time is that you had a combination of a muted growth trajectory really across much of the company, including the iPhone, certainly factoring prominently into that, and a high valuation. So that combination in our mind was not compelling, not something you needed to be overweight on. I think the issue with the iPhone is the feature set innovation and the consumer pocketbook and some question about China. And I think all of those things have, given us data points that are very supportive of the notion that you're in a very muted place right now for iPhone. And I think given that that's something like 50% of sales, very difficult for that stock to have a lot of excitement, I think, if there's not a lot of excitement in the iPhone.
Barton, the basic idea here, I guess, for the bulls is they're running it for profit. If you look at the EBITDA margin from COVID 2019, they've moved from 29 cents on the dollar up to 33 cents on the dollar. Even if they get a Barton Crockett sales lassitude, can they maintain margins?
The company, I think, can maintain margins, but I don't know that that's type of story. Nickel and diming margins, muted growth is something that's going to be really compelling at currently about a 28 PE, 30 PE when we downgraded. I think certainly it's a great company. It's a good company that you could want to own at the appropriate price. But I think you've got to be price sensitive. I think it's a maturing company, and you can't buy it at any multiple, and you can't sit back and predict blue sky multiple expansion in perpetuity with this type of business as we see it right now.
I look at the center tendency of a long-term chart. When you say a pullback, how much would that be? If you do get some negative news out of China, et cetera, is this from 180 down to 160, which is the center distribution?
Certainly we would feel more comfortable with a healthy double-digit return to our price target. I do have some comfort with our estimates and with the street consensus. I do believe that, people have baked in the idea of a very muted iPhone. This is a company you can own at the right price, but it's a mature company price. It's not a growth multiple, I think.
Barton, is this an Apple problem or is this a big tech problem more broadly?
I think this is much more Apple. I mean, we look at some other big tech companies in our coverage, and we see a really great confluence of things developing. Lower interest rates, certainly supporting multiples expansion, certainly favoring scarce growth, which you don't have at Apple, but you do have at things like Amazon. And I think there's been a reset in the internet model. People have understood that you can run these businesses with much better margins, much more efficiently. So while you're nickel and diming some margin improvement at Apple, you're seeing explosive margin improvement at Amazon, at Meta, at Pinterest, at Spotify. Those I think are much more interesting opportunities in this environment.
Never thought that people would say Pinterest and Spotify would trump Apple when it came to potential opportunities. Is it negative enough, in your view, for them to really drop out of the Mag 7, for this to be defined by a very different narrative that Apple is just not included in 2024?
Well, Mag 7, certainly that's kind of, a term of art, I guess. The thing with Apple is I think it's a CPG company. I think that, it's a company that you'll like to own at the right price, in a certain macro environment where perhaps it's defensive. If the economy is slowing, maybe it's more interesting. But you don't need to be overweight Apple in every environment. You should pick and choose your places.
I always wonder what the appropriate multiple on that name actually is. You've got the core good, the iPhone going X growth. You've got a multiple that still looks pretty growthy as the revenue mix starts to shift towards services. Now, Barton, I'm wondering from your perspective, what multiple did you put on that business?
Well, look, I think that it's trading at about 1.4 times or so the market multiple. I think a lesser premium is appropriate. You can give it some premium given the strength of its franchise, the strength of its brand, the durability. The iPhone's not going away. And they've got good cash flow and good share repurchase. So to think that this could be a low to mid 20s multiple makes more sense to me than a 30 multiple.
Barton, thank you, sir, for your insight, the update to a new year. Barton Crockett there of Rosenblatt Securities on Apple with a real struggle to start the year. Pinterest. I wasn't expecting that either, Bramo. Still don't know what Pinterest do.
And Spotify. Well, that's because you're
every time we ask,
you're a guy. I think like 15%.
Is that right?
I mean, like 15% of the audience, I think, is male,
is that
and
right?
85% is female,
Why
something
is that?
like that. Because it's, well, I don't know. I'm actually not on Pinterest, but I have heard from my friends who are actually avid Pinteresters that there is a good way of designing rooms and designing parties and
Men
designing.
Don't like having parties.
I don't. Evidently, I'm a woman and I don't know Pinterest at all, so I really don't know. But that's just the demographics.
Got it.
I'm really digging myself into a hole.
Tom's done some extensive research on this. You know that, don't
this
you?
one?
It's, TK will.
I interviewed
TK will.
Ben,
thank you.
I interviewed Ben Silverman, I'll say 10, 12 years ago. I can't remember now. And I actually went out for like a week and looked at Pinterest like I was on TikTok for 3 hours or whatever. And it's exactly as you say. They attract a certain audience. Their audience has to be female. Some would say more Midwest.
They have to be.
And they're doing this, and the other thing. And it's interesting how each of these social venues, and you could even say it about Apple, they have a culture, they have a character. And I don't know what to make of what Barton just said there about a real inherent, not caution, but just status quo technologically. I mean, what's the new? What's the next for Apple besides some silly vision thing?
I'll go back to what we said multiple times last week. That conversation we had with Barton, we could have had 1 million times over in 2023. The stock finished the year high by 48%. Even with all those things going on, none of that was new. That was the story of the last 12 months, and yet every single quarter we just seem to defy logic sometimes, Lisa, with that name.
Kind of like a phone falling 16,000 feet and surviving. Look, I do think that it's going to have to matter on the upgrading cycle and also on services. I mean, if you start to look at how much you're paying every month for various services that add on.
I've never done that.
I mean,
are you kidding me?
I know, right? It
like
starts to add up.
It's like, why do you need 4 movies today? You know.
What goes on in your household?
I don't know.
I mean, like, don't you think the same thing?
I often wonder. but don't ask too many questions. Coming up on the Open in the next hour, Manus Cranny,
That bill got laid
holding
in
down
the
the fort. Tony DeSpirito of BlackRock, Subhadra Japa of SocGen, Stuart Kaiser of Citi. Stuart out with his Sunday evening note. Not sure how many of you read that, but good news, Lisa. Certainly the view from Stuart over the last 12 months is good news.
And that is what he continues to say. I love that.
Also, the headliner basically said you can always find some bad news beneath the surface, acknowledged there was some weakness there, and maybe discounted what we saw in the ISM services number. But that index, Friday, 10 a.m. Eastern time, wasn't great.
Well, let's go full circle to where we were at 6 a.m., and that is Michael Feroli saying, you know, it's single-digit low real GDP. It's not a recession. It's one-ish. Maybe it's two-ish. You know, and that's what you get. And you get a single-digit equity return out of that.
Already in the swing of things for 2024, very quickly.
Deep into
you just, you know, hit the ground running.
So you're not going to say Happy New Year?
I'm not. I might to the Europeans because they've started their new year this morning because they take their 3-week vacation. And they went back to work today. Did you notice that? I've got so many European friends that went back to work today.
And you're saying Happy New Year to them?
Yeah, my American friends are hard working. They've been going at it since, you know, early January.
Stop.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City for our viewers worldwide, I'm Manus Cranny, in for Jonathan Farrell this Monday morning, desperately trying to find our footing this morning. Equities just turning slightly into the green. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrell.
Coming up, stocks trying to rebound from their worst week since October. Congressional leaders announcing a bipartisan spending deal, and Boeing under pressure as carriers ground the 737 MAX jets. We begin with the big issue, bracing for a big week ahead.
News items I think that are big for this week. CPI coming up this week. CPI
number could be very influential in that market pricing around rates.
Do we get a slight reacceleration?
The Fed, I think, wants to really put that inflation genie back in the bottle.
They need to follow inflation.
Those banks' earnings.
Bank earnings.
Are those sort of strong numbers that we've seen in terms of performance going to hold up?
We are expecting a slowdown in growth.
We really go in and look at the financials for clues on the plumbing of the economy, on the health of the consumer.
The backdrop of geopolitics as well.
We've got tensions boiling in the Middle East, but not spilling over into crude prices.
We've got, Congress back Monday and Tuesday.
The hard work gets to begin now.
It's a major source of uncertainty.
We're kind of trapped in this economic narrative where people are uncertain.
Joining me now to discuss the risk for the week, BlackRock's Tony DeSpirito and Subhadra Rajappa from Societe Generale. Here we are. We are desperate to put in a sure footing this Monday morning. Subhadra, let me bring it to you. First of all, I look at the flow. There's monster flows into cash, way outpacing those into equities. How do you look at risk this Monday morning? What does it take to assure you it's time to deploy?
Yeah, I mean, I think it is kind of a dicey time because you are seeing money flow back into money market funds. Money market fund AUMs are at the highest levels they've been. So there's a little bit of caution from the markets heading into this year because there's a lot of uncertainty on the policy front. There's also uncertainty on the geopolitical front. So I think investors are being a little bit cautious heading into the beginning of the year and where they want to deploy cash. We've seen a pretty significant run up in both equities as well as fixed income in the last couple of months of the year. Financial conditions are extraordinarily easy. The expectation is that the Fed will cut rates at some point. The question is when and by how much.
Yeah, and that is getting trimmed and extended would be my take. Tony, let's roll it out to you. You say safety is not without risk. So I put it in, I get 5 1/8 in a CD, but you say I'm giving up a runway of risk.
Yeah, well, I think we have to look at history as a guide, and history would tell you that investing in equities, particularly the S&P 500 for the long run, has been the best performing asset class. And I use data going back to 1957, which is when the S&P 500 was created. And guess what the average 10-year treasury was over that period of time? 5 3/4%. So well in excess of today's 3.9, 4.0%. What that tells me is that, yeah, bond yields feel high, and same with money market. They feel high relative to our recent history, but they're well in line with long-term norms. And that tells me equities are still a very good place for investors to be.
Okay, well, really all that we're doing is returning to the 1990s, a little bit of volatility, rates over 5%. And you know what? The world didn't stop then. Subhadra, let me bring that to you. Exactly. Unfortunately, I'm mentally scarred from the 1994 bond meltdown. 10-year treasuries, the yield to decline to 3.75 by the middle of this year, but the rise again later in the year to 4% as QT and supply gluts continue to weigh on the long end to rebuilding of term premium. The term premium returns. Subhadra, let me bring that to you first of all. I had BlackRock with me on Friday. They wanted to jump in here. They wanted higher diving boards to jump in. Do you think this is rich enough to dive in here? And then just talk me through your thoughts on term premium. What kind of scale of term premium returns?
So between now and the middle of the year, we think that the market's going to be very much focused on the slowdown in the data. We did see some, the jobs report was very strong. We are seeing some signs of a slowdown in the pace of job creation, as well as in the job market, generally speaking. We think that the U.S. economy goes into recession sometime in the middle of this year. So that in and of itself would mean lower yields from here on. So we think that 10-year yields could rally from around 4.10 now to maybe 3.75. But beyond that, what we're looking at is the trajectory for debt and deficits. I was actually surprised that they were able to pass a deal to avert a government shutdown preemptively. I think that there's very little will, if you will, from Congress to be able to rein in debt and deficits. So if issuance is going to continue to climb and the Fed is going to continue to run off its balance sheet, at least till the middle of this year when they perhaps lower down that cap, and beyond that into the end of this year, then I think you're going to see a rebuild in term premium because someone has to absorb that supply and they're going to demand a term premium.
Yeah, and I mean, by the way, there's still a road to go before we avoid the close down and the shutdown. There's a few holdouts that I'm sure will hold our risk feet to the fire. Tony, given the landscape that you see in front of you, these equity markets took in less than cash. Everybody's telling me it's all about breadth. It's all about the equal weighted S&P that I want to be invested in. I want to look for breadth in 2023. What does that mean to you?
Yeah, so the big opportunity that gets me really excited, yes, 2024. The big opportunity that gets me really excited is the opportunity for stock picking, right? Everyone talks about the S&P, is it going up, is it going down? What's really interesting to me is stock picking. And I think when you look at the equally weighted versus S&P versus the cap weighted, you see this big gap in valuations, almost 20 percentage points. Historically, that valuation gap has been pretty close to zero. I know there's an old expression, it's not a stock market, it's a market of stocks. I really think that applies in 2024. And we even saw it at the end of last year. We saw breadth starting to grow again, the market widening out. That's a really good environment for stock pickers. And so what we're trying to do on my team is exploit some of the anomalies we see. I see defensive stocks as being very attractively priced. I think that's great, particularly given that we're late cycle. I see value stocks. I see a lot of opportunity in value stocks. So the fund I run, the BlackRock Equity Dividend Fund, my PE discount versus the S&P is the largest it's been in the 10 years I've been running the fund. And then finally, I'm seeing select opportunities outside the United States. The U.S. market has done so well. There are some really good companies outside the U.S. that have been left behind. They're global businesses. They're high quality. I've got about 20% of my portfolio in those companies. So those are the anomalies I see, and I'm really excited about those.
Okay, everybody shouts me down on this show. So I'm a transplant from the Middle East and from Europe, and everybody shouts me down when I say, hey, there are some stocks beyond these shores that you might want to be invested in. Stay with us, team. We've got a little bit more work to do. Investors are bracing for a busy week ahead on the inflation front. Mike McKee is with me side by side for a preview. So this core CPI, Mike, should be tempered and should embolden the bond markets. That's the theory.
Well, that is the theory. We've got a busy week ahead, and CPI is the highlight. It comes on Thursday. Some numbers out today, including the New York Fed inflation expectations, may move the markets a little bit. And as you can see, we've got some Fed speakers, Bostic, Williams, and Kashkari talking about the economy, Barr talking about regulation. But it will be CPI that gets the focus because, as you noted, the core rate is supposed to go down. However, the headline rate is supposed to rise by 1/10. And that's a question going into that day of what the markets are going to do, because last week when the European Union had the kind of numbers, and this is all based on base effects rather than real changes in inflation, when the Europeans had that, the markets backed off, the markets got nervous. Now they have reversed that, and does the U.S. already have this priced in for the big change? We'll see on Thursday, and we'll get an indication during the week of what the Fed thinks of both the jobs report and the CPI report. Lori Logan spoke this weekend, the Dallas Fed president. She said that growth is settling down but not collapsing. The labor market still looks tight after the payrolls on Friday. Financial conditions may actually, she said, turn into a tailwind this year. That's a concern for some people, and they can't take a rate increase off the table. Most people in the market's not paying a whole lot of attention to that idea, but it is still out there. And then, of course, she said we should slow balance sheet normalization as we get closer to the bottom level of ample reserves, and nobody knows quite where that is, but she's sort of the first smoke on the horizon in terms of that discussion.
That is a hawkish piece of pie that you're waking up to this Monday morning. Mike, thank you very much, Mike McKean. Tony DeSpirito and Subhadra Rajapal are my guests this morning. Rate hike and a bit of QT, what would that do for you? Tony, let's take it to you first of all.
Yeah, so I think one of the there's lots to be positive about in this market, but one of the challenges for investors is the fact that we are late cycle, right? If you look at the unemployment data, 3.7% unemployment, and that means the Fed really has a tough job of threading a needle. Raise rates too much, you risk recession. Not raise them enough, you risk inflation coming back up again. And so I think that's the challenge for markets. So far, the data has been excellent. We've gotten slowing inflation, yet the economy is held up well. But that's something we've got to continue to watch.
So, Subhadra, do you think, look, no, I'm going to put words in your mouth, but feel free to push back. No probability of a rate hike, but you can turn the screw tighter with QT if you need to.
Yeah, absolutely. I think Lori Logan lays out the risks to policy for this year very clearly. On the one hand, you do have an easing of financial conditions, which is probably going to delay the impact of higher interest rates. We're not in the camp that the Fed would need to hike again this year. We think that they're done hiking. They'll probably cut rates by about 150 basis points. But QT, I think, after they kind of bring down the pace of the runoffs, I think they'll let it run for as long as they can, just to make sure that the balance sheet is in line with where it was prior to the crisis, because they really, to the pandemic, I should say, they really ramped up the balance sheet. So our view is that they'll have QT or quantitative tightening well into the end of this year and perhaps even into early 2025.
So here's one that the world is looking at, but not really. It's sort of like, hands over the eyes. 12% of the global trade is rewriting round the Horn of Africa. This is, in many ways, reminiscent of some of the disruptions that we had going into the pandemic. Tony, to you, is this just a temporary blip in geopolitics and 12% of the world's trade is rewriting, or should I be more concerned about that flashpoint?
Well, one of the things that we've talked about, and this is one of those long-term inflationary risks, and I think long-term volatility risks, right? Which, remember, I think volatility, as an equity investor, I like volatility from a stock picker's point of view. But I do think one of the drivers of longer-term volatility is going to be geopolitics. And I think what's going on with shipping the Red Sea, that's just an example of that. And so that's one of the things that we've been saying is, over the last maybe 15 years, things have been too good in terms of volatility just being too low. We expect volatility to normalize upward. Again, like we were saying earlier, more like the 1990s. I think that's good for stock pickers.
So good vol, bad vol, and I suppose the way to look at maybe this tech drawdown is a little bit of volatility, gives me an opportunity to re-enter on perhaps some of those Magnificent Seven if I was under my allocation to those, Tony. Just quickly on that.
Yeah, no, I do think that's right. And I think a lot of what you saw last week was just a bit of a reversal of what we saw at the end of the year. You saw very strong semis, very strong market, strong growth factor, strong beta. That just came off last week. So I think last week was just kind of a healthy little correction to the exuberance we saw at the end of the year. But exactly, you could use that as an opportunity to reload.
Rational exuberance or irrational exuberance, we can debate. Tony DeSpirito and Subhadra Rajapal stays with me. In the meantime, let's get up to speed with some of the stocks that are moving ahead of the opening bell. Abigail Doolittle is with me. Abby, that Boeing stock under pressure pre-market.
Indeed. We have Boeing down, Spirit AeroSystems, Alaska Airlines, and United. This, of course, after that mishap on Friday when an Alaska Airlines 737 MAX 9, its door plug blew out during the plane's ascent. event. The plane depressurized, a shirt, a cell phone, a teddy bear were sucked out. Thankfully, the plane did arrive safely back in Portland about 30 minutes later. It's not known what is behind this. That Aerosystem, Spirit Aerosystems makes the fuselage panel. That stock really plunging. As for Boeing, given the 2018 and 2019 737 MAX 8 tragic crashes, this is very bad news. The last thing that they wanted was the FAA back in the mix, but the FAA has temporarily grounded the 171 737 MAX 9 aircraft around the world, mainly in the U.S., mainly used by Alaska Airlines and United. Now, ahead of Friday's flight, Manus, this plane in particular, just 2 months old, a pressurization fail light had lit up so that the plane said that it couldn't go on long flights. It's unknown, though, whether that is somehow connected to those wild events last Friday.
Yeah, well, it certainly causes major concerns for the turnaround plan at Boeing. Abby, thank you very much. We'll see you through the morning. Coming up in the show, Congress announces, you got it, a bipartisan spending deal.
We now have top-line agreement on what we can spend for the fiscal year. That's great. It's wonderful. And that just means that the hard work gets to begin now.
The latest developments from Capitol Hill on the way as Congress gets back to work. That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
Now have top-line agreement on what we can spend for the fiscal year. That's great. It's wonderful. And that just means that the hard work gets to begin now. There are so many points of departure between Democrats and Republicans when it comes to the specifics of the spending agreement. There are upwards of 40 different poison pills some groups have counted that could shut down the talks around this. So, look, I think that the temperature has been taken down. The risk of a shutdown is slightly lower this morning, but there's still a lot of work that needs to be done over the next 11 days.
Congress racing to avoid the shutdown, reaching a $1.59 trillion top-line spending deal. Now, the problem is this. The plan doesn't include President Biden's aid to Ukraine, along with some stringent border protections backed by the GOP. That sets a potential battle royal between the White House and the Speaker, Mike Johnson. The Speaker is likely to use Ukraine to squeeze Biden on the immigration changes. And we've had some polls. The CBS YouGov poll says 63% of respondents want Biden to be tougher at the border. What does that mean? How does that translate? Kaylee Lyons is with us. So, Kaylee, here we are, a theoretical deal of $1.59 trillion. But, of course, the Democrats have a side deal as well. So what extra did they get?
Well, basically, this just leaves intact a deal that was made months ago, Manus, between President Biden and Speaker McCarthy, the Fiscal Responsibility Act that helped avert a default by raising the debt ceiling. Largely, those figures are intact, including $773 billion for non-defense discretionary spending. Now, there were some wins for Speaker Mike Johnson here, a pulling forward of $10 billion worth of funding cuts for the IRS, as well as the rescinding of $6 billion of COVID relief funding. So $16 billion in total cost savings that he can tout to his conservative colleagues. The question is really, is that enough for them? Indications are, for at least some, like the House Freedom Caucus, no, they say this deal is worse than they thought. And there also, as you were alluding to, Manus, is the issue of the border. There are a number of Republicans in the House who are saying they would like to shut down the government if they don't get what they want in terms of border policy reform. That raises a very big question as to what exactly the path forward is into finding an agreement that the White House, the Senate, and the House of Representatives can agree to. Potentially Mike Johnson going to talk directly with Biden about this matter, but it may be that border security is both key to unlocking, the supplemental funding request, including aid for Ukraine and Israel, but also keeping the government funded by the time January 19th rolls around. And even though we have these top-line figures, Manus, everything has to be divvied up now into actual appropriations bills, legislative text that has to be passed, at least 4 of them, by January 19th to avert that partial government shutdown. So really, a lot of work is still ahead.
Yeah, there is a lot more technical work to be done. Kaylee, thank you very much. Kaylee Lyons there with the very latest on the theoretical cap on spending. Tony DeSpirito, Subhadra Rajapaksa is my guest this morning. There you go. You have a theoretical top in spending. Are you ringing the rejoice bells, Subhadra, in terms of the fiscal situation? Because in the end of the day, the fiscal agreement is the narrative that will define the Treasury supply.
Yeah, no, I'm definitely rejoicing the fact that there's a potential that we won't have a government shutdown in the next couple of weeks. But the fiscal situation is far from resolved, as you heard from one of your guests earlier on. We still have a trajectory for debt and deficits that's quite dire for the next 5 to 7 years. We're expecting increases to coupon issuance sizes again at the next refunding meeting. There's just a lot of supply that's going to hit the market, and we have to find ways for the market to absorb that additional supply. I think that, especially given that this is a election year, I think it's going to be really hard to come up with very concrete measures to be put in place to be able to deal with debt and deficits. We do have the Trump tax cuts expiring next year. That could alleviate some of the deficit issues. But broadly speaking, I don't really expect a whole lot to be done on reducing the deficits in the next in this year.
And that's a whole host of political issues in regards to the tax cuts from the Trump era as to whether Biden will stand behind those. $52 billion of 3-year notes coming down the pike today. Tony, very briefly, in 30 seconds, election year, you don't expect a squeeze in terms of spend this year?
No, I mean, if you look historically at the presidential election year, it's a positive year for equities. It's slightly below average positive, but it's still a positive year. I see no reason why this year won't be similar.
Okay. We'll ring out the bells for stocks if those earnings come through. Tony, thank you very much. Tony DeSpirito and Subhadra Rajapaksa, my guests this morning on the markets. Coming up, we'll get you the morning calls. Citigroup's Stuart Kaiser makes the case for stocks with the big bank earnings kicking off on the slate on Friday. That conversation next.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
This is countdown to the open. I'm Manus Cranny in for Jonathan Farrell. We're desperate to try and put on some risk on this map. It's been the worst start to cross assets in almost 2 decades. Boeing is the drag, down by over 8% in this opening sweep. We'll keep an eye on that in just a moment. But in the meantime, let me get you up to speed with some of your morning calls from the analysts. First up, Citigroup downgrades Pulte Group to neutral, growing concern about the business model. And falling interest rate environment. Next up, Bernstein downgrades Southwest Airlines to underperform, expecting secular and idiosyncratic cost pressures to weigh on the earnings. And finally, Baird downgrades Wells Fargo to neutral, seeing a more balanced risk reward after outperforming in 2023. How do you fancy your banks? Earnings season kicks off on Friday. Will Wall Street banks define the risk? We'll ask Stuart Kaiser.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
down to the cash open. Are you feeling brave enough to deploy money into stocks? The money market funds and cash have gorged. They took in the most amount of cash in the first trading week of 2024, pretty much on record. There we are. We're going to roll over onto the cash opening. Two big drags. One is Apple, one is Boeing. We'll keep an eye on that. But you're looking at a flash of green across those equity markets at the moment. We'll get you the details on some of the others. Across the assets, this is what you got. The dollar, by the way, had a pretty stupendous start to the year. The euro eking out the smallest of gains, up an eighth of 1%. The dollar on the back foot. Yields drop in the United States of America. BlackRock were with me on Friday. They wanted to step in here. They found the higher diving board to buy bonds. Is it rich enough and high enough for you? Crude drops by over 4%. The Saudis are cutting the price of crude to their Asian market by $2. This is having a pretty negative impact on sentiment, and it underscores the risk of a softer global oil market. One stock to watch, it is Boeing. The shares are poised for the biggest decline since 2022 as the airlines ground the 737 MAX jet. That was after an incident with Alaska Airlines. Abigail Doolittle is on the story. So, Abby, here we are. This is a real blow to Boeing, a blow to confidence. And if I was getting on one of these things, I'd be pretty nervous at the moment.
Agreed. I don't think I would be getting on one of these planes, but right now you can't, because the 171 737 MAX 9 planes mainly used in the U.S., well, they have been grounded by the FAA. This, of course, because of that wild incident you were alluding to on Friday, where passengers literally feared for their lives. A door plug or a piece of equipment that goes into the hole of the side of the plane where an emergency exit could go, it blew out. This as the Alaska Airlines plane, that 737 MAX 9, was leaving Portland. The plane quickly depressurized, and then oxygen masks dropped back down. Within 30 minutes, thankfully, the plane did move back to land back in Portland with nobody hurt. Now, that fuselage panel has been recovered from a Portland teacher's backyard. Spirit Aerosystems makes that piece. Those shares are plunging. But you were mentioning Boeing in this turnaround. So, of course, unfortunately, they had those incidents in 2018 and 2019 when 737 MAX 8, those tragic crashes. So this is very bad news. They've been trying to stage a turnaround, even showing that something could happen with China. There had been encouraging movement there, but now with the grounding of these planes by the FAA, and also it's not clear what caused this. This was a brand new plane, Manus. It had been in the air for about 2 months. In some of those previous flights, a pressurization fail light had lit up 3 times. For that reason, this plane was not allowed to do longer flights. They're not sure if that's correlated, but what we do know is Boeing on the day down 9%, down more than 10% this year, and now down about 50% from its 2019 peak, really not recovering from the issues that it's had with these MAX planes.
Okay, Abby, thank you very much. We'll track that stock through the morning for you. And the Boeing news is spilling over into other areas in the market, as Abby just said. You've got United and Alaska. Those are the two airlines, the two carriers here in the United States that fly the MAX 9 models. They're falling sharply at this opening bell. United turning it around up 0.5%. Of course, the much bigger impact is on Alaska in terms of their schedule. It takes about 4 or 5 hours, we understand, to review these escape hatches. Let's talk a little bit more on the markets with Simone Foxman. Simone, what have you got?
It may take 4 or 5 hours to review these hatches on all these planes, and that's why United and Alaska had initially contemplated returning some of their MAX 9 jets to the air on Saturday after they'd completed those reviews, but then later in the day ultimately decided not to do so. Give you some numbers here about how many jets each of these airlines has. United has about 79 MAX 9 jets, Alaska 65, and Monday flights are also being canceled after a weekend where there were 270 flights canceled for United, 163 for Alaska. That amounts to about 1/5 of Alaska's overall flights. Alaska saying these groundings could continue through at least midweek, but Raymond James kind of downplaying this, comparing this to a bad winter storm for both these airlines. Others, Spirit Air, for example, flies the MAX, but it doesn't fly the MAX 9 and therefore doesn't appear to be impacted. Truist and Bloomberg Intelligence, however, say the real focus is going to be on Spirit Aerosystems. You can see it's down now. They're over 12%. It has already faced a series of quality control issues over the last year. This is a spin-off of Boeing that still makes a lot of its parts for for these major planes. And so a lot of focus there this morning as we get into the start of early trading, Manus.
Yeah, a lot of commentary, Simone, over the weekend about perhaps the management culture, the changes that may need to be taken on board at Boeing. And this is just another moment of deep reflection. Simone, thank you very much. Let's turn our attention to Tesla. We have a journal report over the weekend saying Elon Musk has used illegal drugs and has the board of the EV maker worried. Let's get to Alex Semenova on the story. Alex, and of course, Mr. Musk was on Twitter yesterday pushing back on this.
Indeed, Manus. Good morning. Tesla board members and executives are once again dealing with a very familiar problem, and that is Elon Musk's behavior. Their latest concern is his use of illegal drugs, including LSD, cocaine, ecstasy, psychedelic mushrooms, and ketamine. Quite the variety there. This is according to a report from the Wall Street Journal that says that he's used these drugs at parties around the world, often parties that require non-disclosure agreements to enter them. The report also said that he used illegal drugs with Steve Jurvetson, who is a current SpaceX and former Tesla board member. Musk responded, of course, to these allegations on X, the website formerly known as Twitter. He said that he agreed to 3 years of drug testing after infamously smoking marijuana in a podcast with Joe Rogan a few years ago, and those tests reportedly found no traces of substance use. He also said that he has a prescription for ketamine to treat depression. Now, Tesla investors have often overlooked concerns about Musk's behavior given the performance of the stock under his leadership. Tesla shares are up about 1,000% over the past 5 years, even after falling back in 2022. This includes a gain of more than 100% last year. Still, though, Musk's behavior continues to be a concern for board members and Tesla executives, so much so that one board director reportedly refused to run for re-election. That's according to the Wall Street Journal report. Tesla stock has started 2024 with a bit of a limp. Shares were down as much as 4% as of Friday's close. And they're heading lower again today. Okay, just an eighth of 1% off the stock, 237 on the open. Alex, thank you very much. Let's turn our attention to the earnings slate. Lululemon raising its guidance for sales and earnings after a strong holiday period. Katie Greifeld is with us. Katie, have you been in a Lululemon in the past couple of weeks? Absolutely crowded.
Not in the past couple of weeks, but definitely in the past year or so. But let's talk about what's going on right now, because shares are dropping despite that guidance boost. Manus, the athleisure maker, now expects earnings between $4.96 a share to $5 a share. That is for the fiscal fourth quarter. Previously, that range was between $4.85 to $4.93. Now, Lululemon also expects net revenue to fall between $3.17 billion to $3.19 billion. Analysts were looking for $3.19 billion, so the top end of Lulu's given range. So it's an upgrade to guidance, but evidently not enough to get traders excited here, especially given that this was largely expected. Last month, for example, William Blair had written about the possibility of a guidance boost. That's what you saw today. This is still good news for Lululemon. Lululemon CFO Megan Frank said that sales across all categories, channels, and geographies are, quote, balance that is driving this better than expected performance. And it might help explain why we're seeing Lululemon pare some losses here, currently down about 1%, had been about 3.3% lower pre-market. Manus.
I found an alternative brand, but you'll have to ask me about that off air. there are other brands apart from Lululemon. Okay, Katie, we'll leave it there. Katie Greifeld with the very latest. So the biggest U.S. banks unofficially kick off the earnings season later this week. Bank of America, Citigroup, JP Morgan, Wells Fargo, all will deliver their results on Friday. We will get a greater understanding of our future, won't we? Stuart Kaiser is with Citigroup today to go through these markets. So let's see what the narrative is, the recession, the credit card numbers, etc. Park that for just a moment. I want to hang my hat on your bullish call, because you said cross-asset vol isn't so bad, it's fairly repressed, the ISM wasn't bad, and we had a jobs report which confirmed, if not the immaculate disinflation, but a quasi-soft landing. What the heck is there not to like and love stocks?
Hey, good morning. I think that sort of summarizes it for us, which is, underlying growth data remains strong. Inflation data is kind of, trending lower, a bit higher than you might like it, but, kind of going in the right direction. And then, as you mentioned, earnings kick off later this week, and I think the key theme of earnings for 2024 at large is, do they broaden out? We saw pretty narrow earnings growth last year, which in our view, drove pretty narrow leadership in equity markets, and we're hoping both of those things can, sort of take up a larger group of participants as we move through 2024.
how much of a pro-risk stance is predicated on 6 rate cuts versus 3 rate cuts, or is it, look, that would be nice to have, but I feel convicted on earnings?
Yeah, I think we're a little bit less concerned about the rate cut dynamic. I mean, if you think back to 2023, there was a period of time where you priced almost 100 basis points of rate cuts into the back half of 23, and equities were able to perform quite well even as those rate cuts got priced out. And the reason was underlying growth data was very strong and was surprising consensus estimates. So I think if you're in a similar situation this year, which is, you know, underlying economic growth is strong and those rate cuts get priced out, I think equities can do quite well in that environment. You know, the risk would be those rate cuts get priced out because inflation kind of turns higher. That would be, I think, a very negative outcome. And, you know, I think our view on rates at large is the why matters. You know, if you're cutting rates because of recessionary conditions, that's quite negative. If you're cutting rates for insurance purposes, that's quite positive. And if you're raising rates because of inflation, you know, hooking back higher, also quite negative. So, you know, big picture, we're not too concerned if those rate cuts get pushed out, as long as it's being driven by healthy things, you know, and that would be good growth data.
I just had Tony DeSpirito with me at BlackRock, and what I find interesting, he's one of the first major analysts to join me in this new journey 4 months into the United States of America. He said he had about 20% of his portfolio beyond borders, i.e. outside the United States of America. There are companies, in his view, that can be worthy. To what extent do you want to have a global proportion beyond borders in 2024?
Yeah, you know, I mean, it's a great question. I think last year, early on in the year, people tried to, you know, take a shot at Europe. I think mid-year, Japan was a very popular trade. And I think throughout, you know, people did try to kind of catch a falling knife in China. You know, some of those trades worked, some of them didn't. I think our view in general is, hey, if you're growing earnings 11% in the U.S. and you've got, you know, the Fed poised to cut rates and a solid growth environment, I think you can probably find, you know, pretty strong risk reward in the U.S. itself. So, you know, not a huge appetite right now to look outside the U.S. Just because, again, we think the opportunity is pretty strong in the U.S., whether that's in S&P equal weight or small cap or even some of the cyclical parts of the market that lagged last year. You might even throw banks in that category as well. So, look, I don't think there's a negative outlook outside the U.S. At this point, I think you can get pretty effective risk reward by staying domestically.
You said there's a 40% chance of a 10% bump in the S&P in 2024. Is that going to be slightly more, given what you've just said to me, is that going to be slightly more value to growth?
You know, it could be. I think that's what we've seen early in the year is some money going into value, going into your kind of your cyclical laggards. You know, certainly, you know, that's a 40% chance the S&P is up 10%. I think probably as interesting there is there's a much higher chance of very big upside price into small cap. And I think that would get into the topic you're discussing, which is, you know, do people rotate into this kind of lower quality value stock as the year goes on? And I think it's possible. You know, we do like S&P equal weight to express that view. But again, that's going to be predicated on growth. And I think if you have strong growth data, then that makes growth less scarce. And I think we'll get people kind of more interested in that value and cyclicals trade. But again, I think it all comes back to economic growth and how does that labor market hold in, at least through the first quarter of this year.
And wages are strong, so the consumer you remain convicted on the consumer. There was a wonderful line from Paul Donovan a few weeks ago. Never underestimate or never bet against the U.S. consumerism, the hedonism of the U.S. consumer, and I'm suppose technically one of those now. What's your thinking on the U.S. consumer?
Look, you know, I think you know the rumor of the consumer's demise has been kind of greatly exaggerated throughout most of 2023, and I think part of that is just because we did a lot of fiscal spending in the U.S. and you know part of that, as you mentioned, wages have been strong and the economy has been strong. So, I think for now you just have to you know assume or hang your hat on the idea that the labor market and services spending remains strong, and you want to run U.S. equity risk. You know, our view though is the moment you see you know real confirmed weakness in that labor side of the economy, you need to reduce your equity risk pretty quickly and be very cautious about getting back in. So, look, whether it's credit card delinquencies or, you know, rising jobless claims, things.
Is that why the banks? Is that why the banks reporting on Friday will be so important, Stuart?
Yeah, I think, you know, the banks reporting, I think you touched on the three big topics, right? Is generally speaking, bank CEOs have been very cautious about the economy. They've been increasing credit reserves. And we've had a relatively slow deal calendar through much of 2023. So the question will be, yeah, what is their view on the outlook of the economy? How do they see that credit risk playing out over the next 12 to 24 months? And are they optimistic about an improving deal calendar? So I think those are the three big topics. And the first two of those, you know, credit risk and economy, to your point, you know, really play directly into that view.
Okay, Stuart, thank you very much. Stuart Kaiser, you stay with us. We've got more work to do coming up. We touched on this, but Saudi Arabia, they're cutting their oil prices.
I think OPEC is definitely part of the equation, is a key part of the equation here. The Saudis, I have a hard time seeing them cutting further. Remember, they've been at 9 million barrels a day now for 8 months or so. And in reality, that's the lowest level of production since 2011, if you exclude the COVID period.
Oil prices remain under pressure, as you can see. That is not just pressure, that's brutal. Crude down by 4.66% at 70.41 in the US. Brent collapses by over 4%. We continue that conversation in just a moment.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
What does it take to be a great surgeon?
This may sound trite. Perseverance, resilience, in practical terms, being able to take a blow and not having it become a permanent deformity, and grit.
I do think that geopolitics are a major issue, but it's something really hard to price for markets. So I think OPEC is definitely part of the equation, is a key part of the equation here. The Saudis, I have a hard time seeing them cutting further. Remember, they've been at 9 million barrels a day now for 8 months or so. And in reality, that's the lowest level of production since 2011, if you exclude the COVID period.
Bank of America's Francisco Blanche with me a little bit earlier alongside Danny Berger on the oil markets. Crude is absolutely getting pummeled this morning, down nearly 5% on WTI, and likewise on Brent, down 4 1/4, 75.37. So this market is under pressure. Julian Lee is with me from London. This is quite a chunky move, down 5% on WTI. The Saudis cut prices by more than we expected. Can I put it all down to that?
I don't think it's all down to that. I mean, I do think that's a significant part of it. What the Saudis have done is basically sent a message confirming that they're having difficulty selling their barrels at the sort of prices they were asking. And of course, these price cuts by the Saudis, they're not done in absolute terms. These are done relative to the benchmarks. So this is relative to Brent and relative to WTI. So as those fall, the Saudi prices are going to fall even further. But I think this is really a recognition that the Saudis are struggling to sell the barrels they want to sell, particularly into places like China, which are facing real competition from discounted barrels from Russia and barrels from elsewhere, and all of that coming in large part because of this huge increase in U.S. production and increases from places like Brazil and Guyana.
Okay, Julian, thank you very much. Julian Lee there, setting the stage as oil markets come under pressure. My guest this morning is Stuart Kaiser. I mean, Stuart, from an equity point of view, you've got write-downs coming through. You've got a number of different issues at play there at BP in terms of leadership. Here we are on the commodity side. I've got Jeff Curry coming on the show earlier this morning talking about this is the class of going commodities. He's an uber bull. We know that. Do you temper your inner commodity uber bull?
Yeah, I think commodities and oil in particular have just been a really frustrating trade for folks, through much of 2023. If I told you U.S. growth was going to surprise to the upside, you were going to have wars in two oil-producing regions, and OPEC would be cutting supply, I don't think you would have expected oil to behave the way it did. So, I do think investors got kind of frustrated trying to play that upside trade in oil. It's been a benefit to the U.S. consumer, obviously, that we haven't seen oil prices, rise more quickly. And to Julian's point as well, U.S. production, if you look at that chart, it's at an all-time high. So, clearly the U.S. is trying to fill any kind of supply hole that's being created by OPEC.
I mean, the two big areas in the market are oil on buybacks and dividends and banks on buybacks and dividends. Correct me if I'm wrong, but to what extent will they drive the baseline engagement in both those sectors?
Yeah, look, it's hugely important, on both sides of that. I mean, I guess, in theory, you'd probably assume that the buybacks would have a little more kind of wiggle room to them than dividends. Companies are usually very, very cautious about cutting a div, but maybe see a little bit more flexibility in the buyback path. But look, both of those sectors, energy is committed to returning cash to shareholders, and I think banks are happy to return as much as they're allowed to, by regulators. So my guess would be both of those sectors return as much as they possibly can, and the question is that going to be enough to satisfy, where consensus is at this point? And probably a little bit more risk on the energy side than on the bank side would be my guess.
Let's just close off with where we are. Stocks and bonds. Stocks had a shakedown. Cross assets had a shakedown since the start of the year. Do you want to be a coupon clipper, as one client said, as one guest said to me on IB, in terms of very short date? Does cash play any role for you in 30 seconds? Cash or T-bills, Stuart?
I mean, of course it does. When you have cash yields at the level they are, when you've had, $800 billion going to retail money markets in the last 12 to 15 months, clearly that's a key aspect of things. I think the question is, if you're sitting here and you expect growth to remain strong and you think your cash yield is going to be declining as the year goes on and you just missed, a very large rally in U.S. equities, does that get retail money back into the market? We think it probably does. Not a wall of money, but we do think there's, an incremental amount of money that'll probably come out of retail into the market as long as that economic growth remains stable and they're comfortable with it. So yeah, it's a key consideration, both from a volatility and sort of a horse race kind of perspective in terms of where you want to have your money.
Stuart, thank you very much. Stuart Kaiser, my guest this morning on the markets. Coming up, the market moving events that you need to keep on the slate. Your trading diary, that's ahead on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Citi have just been with us. They say it's time to broaden your reach, go long of the Russell relative to your tech. But the world is not predicated all on rate cuts. It's time to take a little bit of risk, according to Citi's head of trading. Let me give you your trading diary for the rest of this week. The Atlanta Fed President, Raphael Bostic, hits the tape at 12:30 Eastern Time. More Fed speak. You can't get enough of it. New York Fed President John Williams on Wednesday. Plus, it is the deadline for the SEC to vote on, you got it, the Bitcoin ETF applications. Thursday, countdown to CPI and another round of jobless claims. Rounding out the week, it is the big banks hitting the tape, and they will define the trajectory for the mood music across Wall Street. That was it for Countdown to the Open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We got a mixed tape here this morning. Coming up, we're going to get the latest on Boeing. Another black eye for our friends at Boeing. The stock is trading down. We'll check in with George Ferguson. He covers Boeing for Bloomberg Intelligence. And then James Seifert, he's the ETF research analyst for Bloomberg Intelligence. We're going to get the latest. Bitcoin now has a spot ETF. How big is that? Ethan Devitt, she is the CIO at Moneta. She's going to give us her market call, so we appreciate getting some time from her. But coming up, let's go to John Tucker. He is alive. I'm not going to call him well, but he's alive. He's here in our studio.
Just barely hanging on. I don't know. Is that supposed to be good? Anyway, this Bloomberg Business Flash being brought to you by Interactive Brokers. Interactive Brokers charging US dollar margin loan rates from 5.83 to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. I just want to bring this headline to you because it could impact markets. New York Times saying Israel beginning a new and less intense phase of its invasion of Gaza. So chew on that for a minute. The major stock averages, they're mixed after last week's sell-off. You have 5 of the 11 major industry groups in the S&P 500 higher. Information technology in the lead. And after the blowout of that door panel on the new Boeing 737 MAX 9 aircraft, Boeing shares, they were down, let's see, right now, just about 9%. Of course, that's the biggest drag in the S&P 500. Their supplier, Spirit Aerosystems, those shares were down 12%. Lori Calvasina at RBC Capital Markets remains positive on stocks despite the sell-off in the new year.
We still like stocks this year. We actually lifted our target a tiny bit this morning from 5,000 to 5,150. At the same time, back in mid-December, we started warning people that we thought we were due for a pullback in the very short term. And that's really because sentiment, frankly, just got far too bullish at the end of last year.
Energy shares weighing on the S&P 500 right now as oil declines. Right now, Brent crude, that is down 4%, 75.52 a barrel. As for the major averages, S&P 500 up 14 points. That's up 0.3%. The Dow, again, with Boeing there, down 169 points. In the NASDAQ 100, 159 points higher. That is up a full percent. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
Well, John, he sounds okay. I can't say he
sounds
looks,
great.
You know, it's a little
It's
grim.
a great weight loss reduction program because
So this is
you
pneumonia.
can shed, under my new weight loss plan, 10 pounds in fewer than 5 days.
So this was a pneumonia?
A very severe form
Hospital
of pneumonia.
level pneumonia.
Yeah.
Wow.
It was. And I'll tell you, it was. There were other people in there with the same thing. And,
No kidding.
Next room, one of whom did not make it, which was
Let's
really
be careful
sad.
about that stuff.
Yeah,
out
be
there.
careful.
It's
Well,
good
we're so
have John
glad to
Tucker
have
back.
you.
Absolutely.
Who's worked here for 3 decades. Just had his 30th anniversary, and
Not
then this
even
happens.
decades.
Nothing can take
Let's
this man
hope.
down.
We were trying to make it for the next year. It's a little iffy.
All right, John Tucker, thank you so much. We appreciate it. Jess Metton sitting in today. We
Always a
appreciate it.
pleasure.
Thanks for sitting in with us. I misspoke earlier. The SEC has not yet approved the Bitcoin ETF, but we have all these ETF firms filing all their last-minute applications. And supposedly this week we will hear from the SEC.
Yeah,
and the expectation certainly is, if you look at the Bitcoin at 44,700, the expectation is that they might get a positive outcome there. So again, a lot of filings here, and we'll talk to James Seifert.
Yes,
He covers
over at
all the
Bloomberg
ETFs.
Intelligence is
Yep.
going to be a great voice
We'll
on
have
this
all of
coming
that.
up.
So again, we've got mixed performance out there in terms of the markets. The S&P higher, the Dow lower on that Boeing issue, and we'll get to George Ferguson in just a moment from Bloomberg Intelligence to get the latest on Boeing. Let's see what's happening in the markets outside of the indexes.
Carmen Reineke, she joins us. She covers all the markets for Bloomberg News. Carmen, what are you looking at?
Yeah, so we have a big merger Monday today. I'm looking at a lot of stocks in the biotech area. The first one I'm looking at is Ambrx Biopharma, ticker AMAM. It's up almost 100%, 98% right now after Johnson & Johnson said that it will acquire the firm in an all-cash merger transaction for $28 a share, total equity value of $2 billion. This is really big. I mean, that's why the stock is up so much. In the acquisition, J&J will gain a drug that targets tumors. So J&J shares little changed, but Ambrx up a lot.
So Ambrx, I mean, so this is like a biotech company. Again, this is just another example we talk about almost every single Monday. A healthcare or a biotech M&A trade happens, and it's one of these situations where, boom, it just, incredible value.
Yeah, and so continuing in that theme, we have Harpoon Therapeutics, HARP. It's also up more than 100%, 111% right now. Merck & Co. just agreed to buy the company, $680 million. It's looking to shore up its position in oncology. And then the third one that we have here is Axonics, AXNX. Shares, it's not as quite a big of a jump. It's about, 21% right now. Boston Scientific Corp agreed to pay $71 a share in cash. It's a medical technology firm, total equity value of $3.7 billion. It's interesting. I mean, we've been seeing this theme obviously for a while, but I'm really following the places that are scooping up these cancer drugs. Just seems like that's sort of the next big place that all of these.
I wonder if you
big
just go
pharma
out and buy them across the board,
right?
And hope that you hit one of these things. I mean, I'm looking at some of the big holders here. A lot of venture firms on Harpoon, for example, New Leaf Venture Partners, Commodore Capital. Guess who was also there? Citadel Advisors.
Oh, really? There you go. I know you're also keeping a close eye on, obviously, airlines. John Tucker was just mentioning some of these, looking over at Boeing right now. Ticker symbol BA down close to about 9%, so on pace for its worst day since May of 2022. But kind of walk us through how this is spreading beyond just that stock.
Yeah, for sure. So obviously we all saw what happened on Friday with the incident with Alaska Airlines. Those shares are obviously under pressure. It's down a little bit more than 4% right now. That's, the airline that's most directly affected. Boeing is down. Obviously, they're the maker of the 737 MAX. But we're also seeing sort of broad-based weakness in the sector, especially from other airlines that use those same planes. So, United is one of them. And as well as suppliers. So Spirit AeroSystems, which is ticker SPR, is down more than 14% right now. It actually is it's a supplier, and it's also a fuselage maker. So that's part of the plane that blew off.
So it installed the panel.
Exactly. It installed the panel. So it's down, having one of its worst days since August after this. And I mean, I expect it to, or November, excuse me, worst day since November. I mean, we expect this to continue to weigh on this, and we've seen issues like this before where these planes are grounded, and it just, as the regulations and rules are changed and things sort of pass through the system, we're going to be watching the airline industry and seeing,
Yeah, exactly. I'm looking at, Alaska Airlines as well. Another one is off 3.6% today. So kind of seeing it across the board. It just seems like we'll talk to George Ferguson of Bloomberg Intelligence in just a moment on this, but it seems like they just got out of the doghouse from the last 737 MAX issue. And they were ramping up production. They couldn't build them fast enough. And now this. So anyway, we'll talk to George Ferguson on that. So good. So again, a big M&A day, it seems like, in the space. And again, the pharmaceutical space, the biotechnology space, always giving us deals to look at. So appreciate that. Carmen Reineke, thanks so much for joining us here. Carmen Reineke, she covers all the markets for Bloomberg News. Let's get to George Ferguson right now, because he is the expert on Boeing, on aerospace, on the airlines. He's from Bloomberg Intelligence. George, again, we were just saying, it just seems like Boeing just emerged from, the doghouse in the last 6 to 12 months, and here we are yet again. How serious is this issue relative to the last 737 MAX issue?
So, I think if you're talking about the other challenges they've had with sort of rear pressure bulkhead problems and vertical stabilizers, I think I'd put it right along the lines as a very similar issue, and it's a lack of attention to detail in the manufacturing process, either at Boeing or at their suppliers, especially the Spirit AeroSystems. It's been really nagging them, and they've got to get down there at Spirit, and they've got to help them nip this in the bud and stabilize production so they can build all those airplanes they're supposed to build this year and continue the recovery. If you ask me if is it similar to the MCAS problem where the two airplanes crashed, the Ethiopian and Malaysian airplanes, this doesn't appear right now to be anywhere near as serious. I think this will be a singular anomaly when we're all done. But again, a sign of lack of attention to detail in the manufacturing process, which can't go on in aerospace.
Hey, George, give us some size and scope when it comes to which airlines fly this model the most and how many of these planes are worldwide.
Yeah, so I mean, this model is relatively sort of recently entered into service. There's only about 225 flying. The big flyers of them are United, as you mentioned earlier, Alaska, and then Copa out of Panama, and then Aeromexico has some of them too. There's a bunch of small flyers of them. But Copa is another key Boeing customer, right? Copa is an all Boeing 737 fleet. They do a great job of helping people transit between North and South America via their hub in Panama. You don't want to tick your most important customers off, and having quality problems doesn't help that.
George, I'm flying a 737-900 from Friday from Newark to Aruba, so I want you to take care of that for me, please. Go check on that plane personally, make sure it's all set to go on Friday, because I need that plane to leave here.
Aruba.
Exactly. But, George, you can't have quality issues in aerospace industry. You just can't. It's like a zero tolerance kind of thing.
Exactly.
How is this kind of happening here? I mean, I'm just surprised that we're having these types of issues, and with this kind of, it happens, seems more than it should.
Yeah, agreed. I think that it's a function of the setup going into the pandemic, and the U.S. labor market, right? So I think we had this MCAS problem with the MAX. They were grounded around the world. If you were working at Spirit Aerosystems or Boeing, it was pretty depressing times. As you were sort of fixing that problem, we went into a pandemic. Air travel went to zero, almost zero, let's call it. And so I think if you were sitting there at Spirit Aerosystems working in airplanes, you thought this might not be a career that's a long-term career. So I think they've had a lot of turnover, and Boeing's had the same. And both companies said, look, we got to cut costs. We may need to send some senior talent home, give them buyout packages, whatever. So I think both of these companies have seen a lot of turnover in employees. And when you have that, you have to train the new ones, and it just takes a while, right? And so I think both of them need to look at their training programs and their safety programs and dig deeper on that. I feel like, this wasn't something that happened to Airbus, because Airbus didn't go into the pandemic with a problem with their primary, aircraft, the A320, their big people mover. And I think Airbus probably did a better job of managing supply chain, and the European industry managing supply chain challenges during the pandemic. And I think that's why we're here. And the U.S. labor market's been really strong. So you can go out and find another job pretty easy. So Boeing has to get all over this. Spirit does too.
George, it's John Tucker. Quick question for you. Will you explain what the door plug is? The fuselage comes with the ability to put in a door if the configuration requires it. How does that work?
Yes, I mean, some of the larger versions of the 737, some of the customers can really pack them out, right? So I think in a similar airplane, Ryanair will get 200 some people in there. So you need a certain number of exits per number of people in the airplane. So if you're maxing it out like Ryanair, you have an exit door there. If you're not maxing it out like Alaska, you don't need the exit door. You put a panel there. You don't want to lose any of the space at the exit door.
And the panel, that's just bolted in? Or
yeah,
hopefully bolted in?
My understanding is it's got 4 bolts and some other connections to keep it attached to the fuselage. So again, as it goes down the line, someone probably has to go out and make sure that the panel gets inserted correctly. If it's not an airplane that needs that exit door, we think that's probably where the problem was, is inattention to detail.
Yeah, you look at the video from NTSB and whatever. There's no fracturing, there's no tearing whatsoever of the skin of the aircraft.
Agreed. The silver lining to this story is that it does not look like any structural problem. Like you said, it looks like a pretty clean breakaway. And that indicates to us that it was just either the fasteners were faulty, and I think we would have seen that in other airplanes by now. I think the FAA will know that shortly as they do their inspections, or someone didn't fasten it correctly.
How does that end up more broadly affecting other airliners? Like United, for instance, has the most MAX 9s in service, around 79. How does that impact United in particularly as well?
Yeah, so the inspection program, my guess is that all these will have to be inspected, all these airplanes. And so their inspection process is going to take a little bit longer. And these are going to take more airplanes out of service. Hopefully not the, New York to Aruba flights, but we'll see what happens. If they need people to fly those, I get them one of those. And so I think another silver lining here is that it is the first quarter, traditionally a low time for travel. And so I think it's less impactful for the airlines coming right now. But it's going to take United some time, so they're going to have to knock down some of the schedule probably while they wait for these inspections and wait for guidance from the FAA as to what's going to be an all clear for the airplane.
So I know, George, just from reading your research and talking to you, that Boeing and Airbus, they can't build planes fast enough. There's so much demand out there these days. So what happens to Boeing's assembly lines today? Are they still going full board, or are they standing down here? What are they doing?
My guess is that they're probably still building today. My guess is that, they're, like they said, they're very focused on the regulators. They want to see what the regulators have to say. They probably looked closely at this particular station on the line and want to make sure that it's stable. They could even build 737-8s, which don't have this door and wouldn't have any limitations at this point. So my guess is that the production continues.
We only have about a minute left, but we are approaching earnings season. What do you expect as far as particularly how this could impact Boeing when it does come out with some of its forward-looking guidance?
Yeah, I think if it's an anomaly, I would think that Boeing's guidance on how many airplanes they can deliver in 2024 would be largely unchanged from this. It seems to me like this could probably be wrapped up in a couple of weeks. Again, you don't like quality problems, but it could probably wrap up in a couple of weeks if it's an anomaly. If it's not an anomaly, that's when you start knocking down production schedules, knocking down expectations for cash flow and profit. We don't expect that right now.
All right, George, thanks so much for joining us. George Ferguson, he covers all the aerospace companies. He covers the airlines as well. So top to bottom, he's got his finger on the pulse of what's happening in that global aerospace business. And again, Boeing shares are down here today, as are Spirit Airlines as well, one of the suppliers of the fuselages to Boeing. Boeing stock is down about 7.75% here on some pretty good volume here. That's a $140 billion market cap company here. So some challenges.
And also a 4% weighting. When you are looking at the Dow Jones Industrial Average, so when you do see the Dow down about 0.4%, that's why you see that there, whereas not quite as big of a weighting when you're thinking about the S&P 500, obviously.
Yep, good stuff, weighing down the S&P, the Dow in particular. So the Dow's off 138 points. It's about 0.4%. The S&P's up about 0.4%. We'll have more coming up. This is Bloomberg. Get some company news now with Lisa Mateo.
You got it, Paul. Shares of Harpoon Therapeutics, they are skyrocketing this morning. They're up about 110%. And this is after word that Merck is in talks to buy the cancer drug maker for about $700 million. We get more from Bloomberg's Joe Easton.
This company, Harpoon, they make a drug that basically uses somebody's immune system to help fight away cancers and break down tumours and things like lung cancer. And it's an area that Merck's looking to get into. They're already big on cancer, of course. They've got a massive market cap themselves, so they're worth around $300 billion. It's only a $700 million deal, so it's not huge for them.
Now, Merck's top-selling medicine, Keytruda, that is likely to face some pricing pressure at the end of this decade, so they have that for them too. Shares are down about 0.4%. A biotech giant grew its vaccine share, but it's not all good news. Bloomberg's Gina Cervetti has that story.
Moderna managed a bigger U.S. market share for COVID shots last year, even though the biotech giant reiterated a downbeat outlook for the year ahead. Moderna's business has faced rising pressure as the world learns to live with COVID and vaccine demand diminishes. The company said it still expects revenue to fall sharply this year.
Now, Moderna is little changed. Some pharma merger news. Boston Scientific set to buy medical technology company Axonics for $71 per share. That's reflecting an equity value of approximately $3.7 billion. We have Boston Scientific down about 0.2%. Axonics right now is up about 20%. And Johnson & Johnson has entered into a definitive agreement to acquire Ambrx Biopharma. Now, that all-cash merger transaction has a total equity value of about $2 billion. I'm Lisa Mateo. This is
headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with the energy shares weighing on the S&P 500 as oil declines. Saudi Arabia cutting official selling prices for all regions. So let's start with the international benchmark. Brent crude, that is down 4%, 75.62. NYMEX crude, that's just above $70 a barrel. You had that mixed economic data on Friday, capping a week that saw global stocks sink the most since October. And this week, more data. Thursday, get the CPI. And, of course, Friday, earnings season kicks off with the financials. So right now, the S&P 500, 18 points higher. That's up 0.4%. We're at 47.15. Dow Jones Industrial Average, that's where you're going to find shares of Boeing. That's the biggest drag right now, down 120 points overall. That is down 0.3% on the index. The NASDAQ 100 up 176 points, and that is a rise of 1%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Smith and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio, and that's where you will find us. A big week for ETF. Yep, Bitcoin ETF. Bitcoin ETF hopefuls eye this week for elusive SEC approval. The SEC is poised to hold a key vote later this week on pending filings. Almost a dozen firms are vying to launch spot Bitcoin ETFs. I'm not really sure what that means, but our next guest knows all about it. James Seifert, ETF research analyst for Bloomberg Intelligence.
He does it all.
He does it all. He's got a serious social media following as well, because he is one of the go-to folks on this whole thing here. James, thanks so much for joining us here. Explain to us what we are likely to hear from the SEC this week, and why is it important for this whole Bitcoin ETF space?
Yeah, I mean, so we've been narrowed in on this range of January 8th to January 10th for well over a month at this point, saying that we thought approvals were going to come now. And we're still there. We think we're going to see approvals at some point in the next 2 to 3 days. So today or through Wednesday at the latest, we're expecting to see approvals. So
and
that's what...
What specifically is the SEC going to rule here?
Yeah, so essentially to list these Bitcoin ETFs, they have to go through a special process called 19b4. And it's basically these exchanges and these issuers are asking for a rule change. In this case, the rule change is, can we list spot Bitcoin ETFs? And the SEC has a deadline on the first application there from Cathie Wood's ARK and 21 shares that are partnered together. And that deadline is January 10th. And the SEC is likely to basically, we expect them to approve the rule change. We think they're going to allow them to list spot Bitcoin ETFs. So that's step one of 2 steps for these things to list and start trading, possibly this week, if not maybe next week. But that's what we're expecting here. We're expecting the approvals to happen. We think it's not going to just happen for Cathie Wood's ARK, but also happen for all the other applicants. So there's 11 different filers right now trying to launch these ETFs. And we saw a flurry of movement this morning in filings.
Right. So to your point with those filings, especially when it comes to BlackRock, Grayscale, and among these others, who are some of these top names that have gone through with these filings so far in recent days?
Yeah, I mean, if you want, I can rattle them off. I mean, Grayscale is the leader here because they have $26 billion in assets right now. Right now, they've announced their fee only at 1.5%. I wouldn't be surprised if they lower it ultimately before they launch, because currently it's operating as an inefficient trust vehicle that has like premiums and discounts. So a lot of people are upset with that. But the SEC, we think, is ready to greenlight their conversion to an ETF. But you have 21 shares in ARK, who I've mentioned. You have BlackRock. You have Bitwise, who right now is the lowest offering. So they've come in at a fee of they're offering a fee waiver to 0%. So there's 3 different firms offering a 0% fee waiver. Bitwise is down at 0.24% for the expense ratio. Van Eck is down at 0.25%. I mean, these are really low fees. I've been saying for months that I expected these issuers to come in, democratize investing in these funds, drive down costs for end investors, and these fees that I'm seeing are still way lower than anything I was expecting.
Wow. So, James, do these ETFs, if they get approval, do they start going out and raising capital and buying buying Bitcoin? How is this going to work actually in the marketplace?
Yeah, so a lot of them have already raised capital. So there is seed capital on the sidelines. We don't know exactly how much. So there is some seed capital. We know Bitwise has raised 200. Some people have labeled only 2.5 million or 10 million. But we've heard rumors of others that have billions of dollars waiting to invest in these things. So essentially, because of the way these are structured, they're only going to be allowed to do cash creation or redemption. So typically in ETF, you can actually put the underlying asset directly into the fund and then in return get shares of the actual ETF. Right now, the SEC is only allowing cash create. So the only thing that can go into this fund is cash, and then it's on the fund itself to buy the asset. So when all this money starts pouring in, now who knows how much it's going to be. Based on the rumors, it's going to be bigger than anything I was expecting. It's going to be buying of the underlying spot Bitcoin. So there's going to be all these market makers, traders, the Wall Street traders that you think of are going to be out there buying spot Bitcoin for these fund companies.
What would be the timetable if we do hear from SEC commissioners that are expected to vote on those filings this week? So what happens after that, and how quickly can this get through for the marketplace?
Yeah, so like I kind of hinted at this before, there's 2 processes. That 19b4 process, which is that rule change decision, right? That is going to come this week. We think it's going to happen. It has to happen by Wednesday as far as I'm concerned. And that's the first step for these things to launch. The second step is for the S1s or prospectuses or offering documents, these legal documents that disclose how the trust or funds are going to operate, all the risks, those types of things. They also need sign off from another division at the SEC. Now, my initial thinking was that we'd get these 19b4s this week, maybe Wednesday, and then we'd get the S1s at some point later this week or early next week, and then they could begin trading. But once we have both the 19b4s approved and the S1s are effective or complete or approved by the SEC, once both those things are done, within 24 hours, these things are going to begin trading. So it's possible that we could see these things begin trading this week. That's some of the rumors out there right now. People are looking at January 11th. If not, I do think they are going to begin trading the following week at the latest right now. That's my current assessment.
Well, Bitcoin is up about 160% over the last 12 months. Does that mean some of these funds have already been out there in the marketplace buying, or is this thing going to go even higher now once they start getting into the market and buying?
So, great question. I don't know the exact answer to that second part of the question, but the first part is it's unlikely that these funds, and I don't think it's possible for these funds to have been buying the underlying Bitcoin, right? As I mentioned, there is no ability to do the in-kind creation or redemption. So typical ETFs, like I said, you hand over the assets. So in this case, it would be Bitcoin, and in return, you get the shares of the ETF. In this case, the only way to get Bitcoin inside of these these legal entities, these ETFs, is for cash to go in and then for Bitcoin to be bought. None of these funds, none of these documents have shown that these companies have bought Bitcoin through those funds. So any buying of Bitcoin is likely still to occur when these things ultimately list.
To Paul's point, when you have a triple-digit gain in Bitcoin over the past year and it trading over 4,800 today, so how much of that do you think is already priced into it? To your point, saying that potentially there could be more buying of it, does that mean there could be more room here to run for Bitcoin, or is it a little bit more challenging after a big run that it's had over the past year?
It's hard to know. I think it would be somewhat challenging. A lot of this run-up has undoubtedly been because of all this hype around ETFs coming. I honestly, I thought a lot of people were overhyping the amount of money that was going to come into the space, and it's looking like I might have been wrong on that, but I guess we'll find out in the next week or two. That said, the money hasn't been bought. The other flip side to this is, like I mentioned, Grayscale GBTC has $26 billion in assets. It's likely that they are going to see some outflows, some significant outflows, because people were using them for a long time. Some of them were buying GBTC solely to play what I was just talking about, that discount or premium, not necessarily trying to get long-term exposure to Bitcoin. So we'll likely see some outflows there, which will be net selling on Bitcoin. But if there's enough net buying to offset, obviously there might be room to run on the asset. So who knows exactly what's going to happen, but none of the buying and the running up so far in Bitcoin's price is likely from these asset managers buying Bitcoin themselves. It's all been about front-running these asset managers. So we'll see exactly when these fund companies are going to actually buy Bitcoin, but as far as I'm concerned and as far as what I've seen, they haven't done any buying yet.
James, what are the odds that the SEC just says, no, we're not going to approve it?
Well, I mean, this has been the last 8 months of my life arguing with people why I thought the SEC was going to approve these things. And I've gone from completely out of consensus with most people on the street and even in the crypto world to now being the consensus opinion. So it'd only be right if we had Gensler do an old-fashioned crypto rug pull on the industry here. That said, the SEC has spent countless man-hours. These issuers and law firms have spent countless man-hours going back and forth over these documents. There is no way that Gensler would have indicated and had his SEC staff go through all this process if the expectation wasn't that they were going to ultimately approve these things. And he's made, these issuers have basically bend the knee to that cash creation edict I mentioned. They're not allowed to do in kind, which a lot of them did not want to have to do, but the SEC has forced their hand, right? So I don't think it's going to happen. There's a 5% chance here, right? Like Elizabeth Warren hates crypto. Gary Gensler has a close ties with Elizabeth Warren. There's still movement and stuff going on in the back end. So the odds aren't zero that it's going to get denied, but I think they're very, very slim, maybe 95% that we think it's going to be approved at this point.
And James, just about 30 seconds left. If one gets approved, do they all get approved? Is that the expectation?
Yeah, that's our expectation. We saw this with Ethereum futures ETFs, which is a little bit harder to line everyone up because there was only one process, one step to approve. So in this case, we have the 19B4 and the S1. So the SEC has a lot of maneuverability here to make sure that no one can go out in front of the other ones. And we think they want a level playing field, and they're going to probably allow all 11 of these guys to list and launch at the same time. That's our take here. We think all 11 are going to get approved.
All right, James, thanks so much for joining us. Really appreciate it. I know you've been super busy over the last several days. James Seifert, ETF research analyst for Bloomberg Intelligence, really the point person, the real expert out there.
Knows it all.
Yep, and you can see all that research on Bloomberg Intelligence on the Bloomberg Terminal. BI Go is the function to get you there. S&P 500 up about 0.5%. The Dow off about 0.2%, weighed down by the shares of Boeing. NASDAQ up 1.1%. So the tech names kind of ruling the day here. Yields a little bit steadier, 3.98% on your 10-year. Let's head down to Washington, D.C. We get world and national news with Amy Marks.
All right, thank you, Paul. A security official in Lebanon says an Israeli airstrike killed a senior commander of Hezbollah. The assassination comes as clashes between Hezbollah militants and the Israeli military have intensified. Meanwhile, the New York Times says Israel has begun a new and less intense phase of its invasion of Gaza. Airlines around the world are grounding their Boeing 737 MAX 9 jets after a door-shaped panel on a brand new model run by Alaska Airlines blew out on takeoff last Friday. We get more from Bloomberg's Henry Lee.
In the recent months, we have seen serious manufacturing and quality lapses, not just on the part of Boeing, but principally responsible Spirit Aerosystems. They are the main supplier to Boeing on this MAX jet.
And Bloomberg's Henry Lee reports the damaged aircraft was delivered to Alaska Air only this past October. Boeing shares now down more than 7.5%. There are growing questions about why the defense secretary's recent hospital stays were kept from the White House and the public for days. People familiar with the matter tell Bloomberg the Pentagon's failure to notify the president was the result of a series of errors. Secretary of State Antony Blinken says he didn't find out until after the fact either.
I wasn't aware of his medical issue. In fact, I talked to Lloyd last weekend.
Sources on Austin's team say the failure to notify Congress and the White House was unacceptable and it cannot happen again. The risk of a shutdown on January 20th has been eased somewhat. Word now of a deal on spending caps. Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson negotiated a bipartisan deal capping spending at $1.59 trillion. So for now, lawmakers have a framework that would avoid a government shutdown this month, and the next deadline is February 2nd. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The Dow is lower. Shares of Dow component Boeing plunge with a grounding of its 737 MAX 9 jets. Right now, the Dow is down 58 points, pairing some of the earlier losses down about 0.2%. The major indexes saw a 9-week win streak come to an end on Friday. Meantime, cryptocurrency exchange Coinbase rallying after a price target hike. Headlining this week's economic data, a couple of big inflation reports. The December Consumer Price Index, that's due out on Thursday. And Claudia Salm at Salm Consulting says Fed rate cuts and a soft landing pretty much remains a guessing game.
The Fed is trying to do the impossible right now. My heart goes out to them, and we will play a parlor game for the next year or two and what their next move is. It's about getting inflation down. It's about keeping people with jobs. And we're well on our way, but it's going to be tough to know when they're there and can say, okay, we can back off.
Well, banks launched their fourth quarter reporting season Friday. JP Morgan, Chase Bank of America, Citigroup, Wells Fargo lining up to report. Right now, the S&P 500, 24 points higher. That's up 0.5%. We're at 4721 on the index. And the NASDAQ 100 up 195 points. That's up 1.2%. And keeping an eye on crude oil, that's the biggest drag in the S&P 500. Energy to say. Right now, Brent crude down 3.6%. NYMEX crude 4% lower right now at $70.77 a barrel. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. And I would say that under $3 a barrel, $3 a gallon, that is, pretty much routine now on the roadways of New Jersey.
Absolutely. Down the Jersey Shore, just filled it up. The BP station on Route 35, Wall Township, got a 297. Pretty happy about that.
There you go.
Yep, pretty happy about that.
297.
Yeah,
this is what excites us, Jess.
That's right. So inflation you can feel. Inflation you can see is coming down. John Tucker, thanks so much. We appreciate that. Just met and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio here.
You know, I was looking at AAA gas prices around just over $3 a barrel nationally.
Yeah,
so you look at that latest one, yeah.
Except for California and those taxes.
Oh, of course.
Brutal. All right, so I'm looking at the SPX here, off about 1% so far this year, but that makes plenty of sense given the huge rally we had there in that last 10 weeks of 2023. So I think a lot of folks are just trying to kind of get their footing here in the new year. So let's check in with somebody who's got a professional opinion, Ethan Devitt. She's the Chief Investment Officer for Moneta Group. Ethan, first of all, I'd love to just get your opinion of kind of what we saw there in that last 10 weeks or so of 2023. Just a heck of a move there, both in stocks and bonds.
Exactly. It was an extraordinary turn in sentiment that we saw in both stocks and bonds at the end. Really, a lot of it came from things not being as bad as had been anticipated, certainly, and not as forecast throughout the year. And then because the Fed certainly looked like it was about to pivot or to pause, and it gave that message fairly loud and clear at the end of the year. That was all that markets needed to really take off. We saw it both on the bonds and the equity side. And this is the new world order we are seeing today, this correlation, positive correlation of bonds and equities. So no surprise that they moved in sync.
What's your view on the U.S. stock market, in particularly for your outlook in 2024, and how are you advising your clients to position?
Well, certainly we have never advised our clients not to be in equities. We have always been a very firm believer in the need to have a balanced portfolio. Even though bonds looked meaningful throughout 2023, and as inflation came down, they look more meaningful. They still don't stack up relative to the growth that's been seen in the U.S. stock markets in particular, and most of our clients need to have growth as part of their portfolio. So we cannot abandon equities. I am a little concerned about the lack of breadth in the market, and we have never had a very focused portfolio on certain sectors. We've always had breadth that hasn't been rewarded. We believe it will be rewarded in 24.
And we saw a little bit of that, again, in that rally in the year end. We had the Russell 2000 outperform. We had the equal-weighted SPX outperform. So the breadth seemed to have improved a little bit towards the end of last year. Do you expect that to continue this year?
I do, and the reason I would look at that is I look at the disparity in terms of earnings. Even though the Magnificent Seven are north of 30% in terms of the market's returns, they are not in terms of the earnings. The earnings have actually been steady across other sectors, and we expect to see that get rewarded soon. There's been a lot of very good news behind the scenes because of the strong consumer, the resilient consumer. They've been able to maintain demand, and a number of companies have been not had that margin squeeze that they would have had when they were seeing higher energy prices and a higher labor pressure. So a lot of that has gone away. And as earnings would improve, which we expect to see them continue to improve, we do expect that breadth will continue to percolate throughout markets.
Looking at one of the BI functions here, if you want to see where the outlook is for fourth quarter earnings season, just over 5% growth for overall for the S&P 500. If you look over at the latest Atlanta Fed GDP model, growth coming in around 2.5% for the fourth quarter. So strong there, but obviously not quite as strong as what we saw in the third quarter, which was close to 5% growth there. What I'm wondering from an earnings perspective versus where we're seeing economic growth, I mean, obviously it's decelerating, but nowhere near a recession for clearly there. So I'm wondering, do things need to get squared away when you're viewing where earnings growth is projected to be for the year, which is a little around 11% versus where economic growth is projected?
A very good point. And I'd say that we're still not really in a normal zone when it comes to those kind of quarterly growth figures. We're still going to see a little bit more volatility in that because of COVID and the distortion that had really put into the system. So in terms of what we're likely to see for the earnings growth, I think what we're seeing, the companies have done very successfully throughout 2023 is they have managed